Hello, I'm Carolyn Grimm of Accounting How To. That is my sidekick Terrence. We put the fun in accounting fundamentals. Now, we put together this very special playlist for college students who need to learn the basics of accounting quickly. Maybe you forgot to study, or maybe your accounting professor sounds like Charlie Brown's teacher. Wah, 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 wah. Or maybe you're trying to take accounting online and it's not going so well. Well, we can help with that. So the first 4 chapters of your first accounting class are the most important chapters of all, because everything we cover in the first 4 is the basis for everything else we do in accounting. So if you don't have that good foundation, you will struggle with everything else that comes after that, whether you take 1 accounting class or 20 accounting classes. So grab a snack, grab a beverage, and settle in for a crash course in the ABCs of accounting. You'll be glad you did. If you do a search online for how to pass accounting class, you'll find the following advice. Do your homework. Well, duh, of course you should do your homework. But what really determines your success in accounting class comes down to 4 important things. And I'm going to tell you exactly how to not only pass your first accounting class, but to get an A. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Let's jump right in. Now, it doesn't really matter what the name of your first accounting class is, whether it's Principles of Accounting or Fundamentals of Accounting or Financial Accounting, and it doesn't really matter what textbook your class is using because they're all the same. Now, the first thing that you need to understand about accounting class is that it's different from other classes that you've taken. So you're building technical skills. And it's not like those classes where if you're taking a test, you can just keep talking and talking and talking until you finally make the teacher think that you must know something because you threw in a lot of the right words. Accounting doesn't work like that. So in accounting class, you're building technical skills. And it's not unlike learning to be an electrician or being a gamer, right? You have to learn how to conquer one skill or one level before you move on to the next. So the most important 4 things that I mentioned are the first 4 chapters of your accounting textbook. And really, it's the second, third, and fourth that are the most important. So here's why. Those first 3 or 4 chapters are the foundation of everything that you will do in accounting from that point on. So chapters 1, 2, 3, 4, when you get to chapter 5, you're going to need that information. And without it, you're going to be lost. And I've had thousands of students through my accounting classes over the years. And every single time they don't get those first 4 chapters, they struggle the rest of the time. So it's not like a kind of a thing where, oh, you messed up on the first chapter. In the 5th chapter, you'll just catch up. It doesn't work that way. You've got to get chapter 1, 2, 3, 4 before you can move on. So you can't jump into chapter 3 first. No, my friends, it doesn't work. But if you nail those chapters, and I'm going to help you do that because that's what I do, then you are setting yourself up for success. You're setting yourself up to get an A in accounting class. And who doesn't want an A in accounting? Now, every concept that we're going to touch on in this video, there will be corresponding videos or groups of videos that will go into those concepts and the application of those concepts. And you'll find those links in the video description. So let's start with chapter 1. In chapter 1, what we want to do is we want to get used to the idea that accounting is a system. And we have this thing called the accounting equation, which is introduced right off the bat in the first chapter. And the accounting equation is how we track all of the different transactions that happen in a business. And we put them within this structure, this accounting equation. And we increase and decrease different things in order to keep that equation in balance and to capture all of the information that we need. Chapter 2 gets into the extremely important concept of normal balances and the rules of debit and credit. And again, don't get worried about that because we're going to have a video that talks about those things. So chapter 3 is all about making sure that the balances that we have are the right balances, that we are not overstating or understating a balance, because that's going to travel through to our financial statements, which is the whole reason we do all of these transactions. So the adjusting entries are going to be additional journal entries that we do every month to make sure that our accounts have the balance in them that they should. And then chapter 4, we do something called closing entries. And closing entries are kind of that tail end of what we call the accounting cycle. So we start out, we do all of these transactions, we do our journal entries, we do our adjusting journal entries, etc. The closing entries are the things that kind of return all of our accounts to the balances they need to be starting in the new month. Again, don't worry about all of that yet, because there are videos that are going to walk you through each and every part of that so that you can really do well in your accounting class and you'll really have a good understanding of how all of these pieces work together. But as with any skill, the best thing that you can do is to learn the concept and then practice, practice, practice. So let's come back to that gamer example that I used. Right? You're not going to go in and expect that you are going to jump right into level 10 without having gone through level 1. You're going to learn the secrets for each level as you go through. And it's the same thing with accounting. So as you go through those first 4 chapters and the videos that go along with each of those, understand that you are building a foundation. And that foundation is what's going to determine whether you struggle moving forward in accounting or not. And you shouldn't struggle. I don't want you to struggle. I want you to understand the concepts as you go along. Now, the good thing with YouTube videos is you can watch them over and over and over again. And if you doze off while the instructor is talking, you can go back and rewind. It's all good. And oh, by the way, you should read the textbook and you should listen to the lectures and you should do the homework and the quizzes and the tests and you should ask questions. Okay, I'm a teacher. I'm required to tell you that. And the reason I'm required to tell you that is because it's a method that's worked for thousands of years. I mean, just ask Terrence. He knows. He was actually born when dinosaurs roamed the earth. Hey, Terrence, why are dinosaurs extinct? Because they didn't read the textbook. It's okay. You don't have to laugh at my jokes because I'll laugh at them for you. Your next step is to see the playlist for Accounting 1, which is down in the description. And it will take you through absolutely everything you need to know in order to do well in those first few chapters of accounting. So I'm really glad that you're here. I'm glad that you've discovered this channel because it's going to help you to get the best grade you can in accounting. But even more important, it's going to give you that great foundation for moving forward in whatever accounting class you take. So go ahead, jump into those other videos, and start to really learn the fundamentals of accounting. Until next time, stay balanced, my friends. And once you start to study accounting, that will make sense. I'll see you next time. Taking accounting as an online class is sometimes more difficult than doing an in-person accounting class, both for the students and for the professor. And if it's harder for the professor, that means it can be harder for the accounting student. But I'm going to give you 7 tips to help you get an A in your online accounting classes. So welcome to Accounting How-To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Now let's dig right into this plate full of juicy tips. Tip number 1, You've already discovered this one. If your professor isn't doing video lectures, or you don't understand what the professor is telling you, go directly to YouTube. Do not pass go. Do not collect $200. Go directly to YouTube because there are excellent tutorials available on any topic that you're studying, including accounting. Tip number 2, if you have questions, reach out to your professor. We are being paid to teach you. And any professor who is teaching for the right reasons truly wants you to succeed. So they're going to help. And if you're like me and you had a dud for your first accounting professor, really bad, reach out to a different professor. Don't hold back. Seriously, never let a bad teacher hold you back from learning the material. Okay? Tip number 3, your college has learning advisors, tutors available to help you. So reach out to your learning and advising center, your librarian, whoever is there in an information role, and find out what the resources are that are available at your college. There may be free tutors available. Don't wait too long to do that. As soon as you feel like you're getting into trouble, reach out. Because the nature of accounting classes is if you don't get the fundamentals, you will struggle all the way through. So as soon as you're feeling like that first couple of weeks, I don't get what's going on here, absolutely the time to reach out. Do not wait until week 5 of the semester or week 15 of the semester. Do it as soon as you feel like you're not getting the material, okay? Don't struggle with that. Just go get whatever help is available. Tip number 4, and this was a big one that I saw students run into when we went from classroom to online. Technology issues. You've got to be proactive about technology issues, whether you've got a computer that's not working well or you're struggling to get good internet. You've got to be proactive about that. You can't let it slide. So if you don't have good internet or you tend to lose internet, or you have weak internet where you are, make a plan so that you're either going to the college to access their internet or you're going to the library, whatever you need to do to proactively make sure that you have access to your classes, you've got to do that. And don't wait. Please don't wait. Because you don't want to be 6 weeks into the semester and emailing your professor saying, yeah, I didn't have internet, so I couldn't do my homework. You're going to just really make yourself miserable. Don't do that. So be proactive. Tip number 5, we've already touched on this one. It doesn't matter what accounting class you're taking and whether it's in person or online or hybrid, the fundamentals are critical. So everything we do in accounting classes builds on the lessons from the first 4 chapters of Accounting 1, your very first accounting class. So here's what I'm saying. Accounting Jedi, master these you must, because everything else is going to build on that. Tip number 6, there's no substitute for working at it. Read the textbook, ask questions, listen to the lectures, do the homework, study for the tests. It's old school, it's OG, and it works. Tip number 7, you have vast resources at your fingertips, way more than I did when I was learning accounting in the cave with dinosaurs outside the window, okay? You have vast resources. Use them. And hey, subscribe to my channel because you know what? I've got your back. Everything you need in accounting, I can do a video. So please reach out, ask questions, make suggestions for videos you'd like to see. I've got your back, okay? Until next time, stay in balance, my friends. So I am hard at work today, preparing a new class. Now, it's not a new class for me, but it's a new format of a class because it's going to be all online. So I thought it would be a good chance to walk you through how to study for accounting, because it's the same process that I use that you can use to help you do better in accounting. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. And we're here to put the fun in accounting fundamentals. So here's the thing about studying accounting. It's different from a lot of your other classes. In some classes where you're learning about, management or organizations and interpersonal relationships and things like that, it's more of a exploring how you feel about things or studying the way other people have done things. But with accounting, you actually have to dig in, learn how to do the thing, and then how to apply it. So there are right answers and wrong answers in accounting. And it's not one of those things where you can just start talking and eventually your instructor will be like, okay, you've shown me that you know something. Accounting is different. It's more like learning a language or learning a software package. So if you want to learn a new language, you don't wait until the night before and then try to cram everything you possibly can into your head before you leave the country. You want to start way before that. So with accounting, the first thing is you never want to wait until the last minute. But let me walk you through how I actually prepare for a class, because I think it will be helpful for you as well. So the first thing I do is I open up my really large accounting textbook. And what they don't tell you about accounting is you got to be really strong. You know, these books are heavy. The first accounting class I ever taught, I ended up with bursitis of the elbow because of the heaviness of these books. But the first place that I start is I want to get a high level view of the class. I want to understand what's ahead on my little road trip through accounting. And you find that out by going directly to your syllabus. Or if you're like me and you have to actually create the syllabus, you're going to go to your textbook first. So I'm going to look at our table of contents and I'm going to get a good idea of what things need to be covered in this class. And I know that in this class, this is a 2-semester class, so we're going to be dividing the textbook up into basically halves. And that's the amount of material that we need to get through. So then I start to kind of map that out. And I look at it and I say, so we've got in this book 5 parts to the book, and each book has a bunch of chapters to it. So I know that we're going to cover part 1 and 2. It's going to be approximately 9 chapters. And then I start to put together the structure of the course. So as I start to build this out, what I'm going to do is I'm going to actually go to the table of contents and I'm going to look at what chapter 1 is supposed to cover. And when you look at a table of contents, you'll see that it has bolded or highlighted areas, and that's your chapter outline right there. Those are the big topics that we're going to be talking about. So I kind of familiarize myself with this, and if I was going in to take an accounting class, I would look at this before the class, right? So I can at least have an idea of what we're talking about, and I'm not going in completely ignorant of anything that's going to happen in the class, because this gives me a heads up about what we're going to cover. So once I've familiarized myself with the table of contents and with the outline for that particular chapter, the first thing I do when I'm doing a new chapter, either preparing it or if I'm studying something myself, is I go to the very back of the chapter. I don't even read anything in the chapter yet. I go right to the back of the chapter and I look at the review center or whatever that review area of the chapter is called. And I go right there because what that's going to give me is it's going to give me the key points for this chapter. It's going to be called key points or key takeaways or something along those lines. And what I'm going to do is I'm going to read through those, because that's going to really give me a heads up as to what the authors of the textbook thought was important. And if the authors of the textbook think it's important, there's a good chance that your instructor, your professor, is going to think they're important too. So the next thing that I'm going to do is I'm going to put this book down because it's really heavy. Wow. And then if you want to continue with that road trip analogy, because who doesn't like a good road trip? Love road trips. So you can think of those landmarks as being kind of like those mileposts along the way that tell you where you need to go next. And then you can look at something like your homework and think of that as kind of like a tourist guide. You know, your tourist guide will tell you when you're in this location, be sure that you don't miss these things. And that's what your homework is doing. It's saying, these are the things from the chapter that are important that we want you to know. It's your opportunity to practice the concepts of the chapter. That's what you're doing. You're practicing this new skill. So if we're talking about a language, you're going through and you're repeating the phrases that you're learning for that particular chapter. And with accounting, every time you practice something, you get better at it, you build a stronger foundation. So once you've hit all of those must-see items on your homework, and you're feeling comfortable that you've mastered how to do those things, and it's all about how to do those things. It's how to do this journal entry or how to handle this kind of a financial transaction. Once you've done those practice rounds, that sets you up for your quiz or your test. And quizzes and tests, you can think of them like river crossings. Like if you get across the river, which is your quiz or your test, then you know that it's okay to go on to the next thing, because everything with accounting builds on the stuff before, right? So if you miss something in chapter 1, you're going to struggle in chapter 3, and it's going to come back to haunt you in your next accounting class too. So it's really important that you go through all of those steps in order to master the material. And then coming back to my class prep, I'm going to go through that for every single chapter. I'm going to look at the table of contents. I'm going to scan through that. I'm going to go to the back of the chapter. I'm going to say these are the key points. Then I'm going to have a list of videos or a list of lessons that I need to cover for that particular chapter. And then I'm also going to be looking at the homework and the quizzes and saying, what are the most important things that we want to make sure students know before we move on to the next lesson. So that's it. That's how I prep for a class. And if you use that same formula for prepping for your classes, you're going to do so well in accounting. So until next time, stay balanced, my friends. I thought about calling this video The World According to GAAP, but I didn't think a lot of people would get that. If you get it, please comment and let me know I'm not alone in this. So what if every accountant made up their own rules? What if every company reported financial information in whatever way the employees felt like doing it that day? What would happen? Chaos, that's what. Confusion, deception. In this video, we'll be talking about GAAP and how it helps businesses, investors, and accountants all play by the same rules. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my always GAAP-compliant sidekick, Terrence. And we're here to put the fun in accounting fundamentals. But first, some history. Now, some of this history may seem oddly familiar, but travel back with me in time to 1929. The world, including the United States, had just gone through the devastation of a world war and a pandemic. Millions and millions of people worldwide died because of those two events. And after all that heartbreak, Americans were ready to party. But not with alcohol, since that was prohibited by the 18th Amendment. I'm kidding. Black market alcohol was readily available. Well, with all that dancing and drinking and partying, people still found time for their other hobby, investing in the stock market. And all that investing activity led to lots of speculation and, of course, fraud. And it all culminated in panic as the stock market started to drop. And October 29th, 1929, a day known as Black Tuesday, stock prices completely collapsed. Billions of dollars were lost, and investors were wiped out. And this crash, along with other factors, plunged the U.S. into what we now know as the Great Depression. So what does all this have to do with GAAP? Well, it led the American Institute of Accountants to recommend to the New York Stock Exchange some rules, some principles of accounting that were generally accepted and would provide consistency on how financial information was reported. And then this led to various acts by Congress meant to restore public and investor confidence in the stock market, because no confidence leads to people not buying stock, and no stock buying means that corporations can't raise the capital they need to expand. And this impacts the number of jobs that are available, which impacts people's ability to buy more stuff, which limits the revenue of corporations, etc. So the whole role of GAAP is to provide assurance that financial information is giving a true picture of the financial health of a corporation. Now, GAAP applies to U.S. companies. There's also global standards called International Financial Reporting Standards that are meant to provide ruling principles for all businesses. The U.S. has not at this time adopted those standards, but GAAP and IFRS have many similarities and some differences. Now, GAAP is broken up into 3 different categories. It's broken up into assumptions, principles, and constraints. So under assumptions, the first assumption is that a business is separate from its owners. So what that means is that if a business earns revenue or has expenses, that is not the owner's revenue or expenses. It belongs to the company. So this is called the business entity assumption. And we keep track of each business entity separately, and personal expenses would not be included in a business's records. Second one is going concern. This assumes that a business is going to continue on into the future. This is important when it comes to things like depreciation, because we are depreciating assets based on the assumption that that business is going to be there in 5 years or 7 years. The third is the monetary unit. So it's assuming that we have a stable currency, and for the US, that currency is the US dollar. And fourth is the time period principle. So that tells us that economic activities can be divided into time periods like a month, a quarter, or a year. And this gives us the basis for that time that we're looking at for sets of transactions. So a month is a unit of time, and we're going to encapsulate that month's activities within that time period. And then we talk about principles. So GAAP principles, the historical cost principle is the first one. And this tells us that we are going to record assets and liabilities at the acquisition cost. So if we buy a truck, we're going to record it at the price that we paid for it, even if we got a smoking good deal on it. And if we take out a loan, we're going to record it as the full value of that loan. We're not going to use fair market value, although there have been some pushes towards using fair market value. At this point in time, we're still using historical cost principle. The next one is the revenue recognition principle. Revenue recognition principle says that revenue is recorded when it's earned, not when we receive the money for it. And if you've seen the cash versus accrual basis accounting video, which I'll link in the description, you know that cash basis, we record revenue when we receive the cash. So revenue recognition principle is talking specifically about accrual-based accounting. The next is the matching principle. And if you've watched any of my other videos, you know I come back to the matching principle a lot because it's really important. It is the basis, along with revenue recognition, of accrual accounting. So the matching principle says we want to take the expenses and match them to the related revenue. So if we buy merchandise, we want to match that purchase of merchandise to the revenue that we get for selling that merchandise. So the matching principle and the revenue recognition principle are the basis of accrual accounting. And then our fourth principle is full disclosure principle. And that says that we should be giving as much information as is necessary for a prudent person to make financial decisions, but not so much that it becomes extremely costly to gather that information. Like we wouldn't put serial numbers on every single nail in a 50-pound box of nails. That would be crazy. We'd be able to track each and every nail, but it would be just an insane amount of detail. So we want to balance that information. It needs to be everything that's really important, and the stuff that isn't so important, we don't really need to include. We can do things like
make a disclosure note in our financial statements. For example, maybe there's a lawsuit that's been filed, but we have no idea what's going to happen with that lawsuit, but we do need to tell people that it has been filed and we don't know what's going to happen. So that's a piece of information that we would disclose, but it's not necessarily going to show up in our balance sheet because there's no details or concrete information that we can put into our financial statements at this point in time. Now, we also have some constraints. The first one is the objectivity principle. So this says that financial statements should be based on objective evidence. So for example, we have invoices that add up to the amount of our revenue. So we've got something to back that up with. It's not just a number that we pulled out of the sky. We have bills and canceled checks that will match our expense numbers that we're reporting. So objectivity says we've got to have some actual evidence and some real stuff to back up our numbers. We can't just make them up. Then there is the materiality principle. The materiality principle says, is this item of significance for this business? So for example, if your bank reconciliation is off by a penny, this is not a material number. A penny is not a material number for pretty much any business. So if you make an adjustment rather than finding that penny for 1 cent, it's not a big deal. Rather than spending 40 hours of your bookkeeper's time trying to find that penny, we're just not going to give it a lot of attention. But if it's a $10 million difference in our bank reconciliation, that's material. And this can depend on the size of a business. If it's a $1,000 difference in inventory for a really large business, it's not material. But if it's $1,000 difference in inventory for a small retail store, that's material. So there's some judgment there that goes along with that. Then there's the consistency constraint, the consistency principle. We want to make sure that we are reporting things from month to month in the same way. So for example, we can't take our depreciation and every month just change it to be whatever we want it to be. We have to pick a method and stick with it. When we're talking about inventory, we're going to pick one inventory cost method and we're going to stick with it. So we're going to use FIFO this month and FIFO next month and FIFO the month after that. And it also tells us that we cannot switch from the accrual basis this month to the cash basis next month and then to the accrual basis again the month after that. Then there's the conservatism principle. If you have two choices, you want to choose the less favorable outcome. If we are looking at a situation where we say, should we recognize this expense this month or last month? The one that has the less favorable impact on profits is the one that we're going to choose. Now, I will say that this works out really well if you're deciding whether or not to eat a donut, right? The least favorable outcome would be that you eat the donut. I'll leave that with you. Now, the last constraint is the cost constraint. The benefits of reporting the financial information need to outweigh the cost of supplying it. So this goes back to that 1 cent difference in our checking account. Would it be more accurate for us to find that 1 cent? Absolutely. But would it be cost effective? It would not if you've got to pay somebody multiple hours in order to find it. And then there is one final rule. If by following any of these principles, it means that we would be misstating material information or providing misleading information, we don't follow GAAP. We depart from GAAP. And we disclose then why we did not comply with GAAP. And that would be a rare occurrence. So you can assume that you will be following generally accepted accounting principles, and then you won't go wrong. So until next time, stay balanced, my friends.
Did you know that one seemingly simple equation holds the mysteries of the entire universe of accounting? It's true. And I'm about to unlock those mysteries for you, because that's what I do. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Let's jump right in. So the accounting equation is so important to accountants that some of us, well, one of us, has had it imprinted on a t-shirt. Now, what is it about the accounting equation that holds so much magic? Well, let's explore that. So the accounting equation looks quite simple. It's assets equal liabilities plus equity. Three little things that hold so much magic. So let's start with that concept of the equation. So the accounting equation must always be in balance. Okay? Let's start there. That means if you do something on one side of the accounting transaction, the other side of the accounting transaction must also be the same number when you're done. So if you add $1 on one side, you've got to add $1 somewhere on the other side. If you add $1 and subtract $1 on one side, the other side will also end up being 0. So what we're doing is we're tracking changes in that accounting equation. And those changes are what we would call transactions. So you buy something or you sell something. And every one of those transactions creates a change in the business, and therefore it creates a change in the financial situation of the business. So it changes our financial statements. So let's talk about each one of those components of the accounting equation. The first one on the left-hand side is assets. So assets are something that a business owns. So it could be cash, it could be inventory that we bought to sell to our customers, it could be a piece of equipment or a vehicle or a building. Those are all examples of assets. It's something that the business has that has value. Another type of asset would be something called accounts receivable. And accounts receivable exists because you have sold something to your customer and your customer hasn't paid you yet. You're owed the money by your customer and you expect that you will get paid for it, but you don't have the cash yet. So accounts receivable is a holding tank for the money that is owed to us by our customers. So it's an asset because it has value, and the customer will eventually pay us that money, which will then move it from accounts receivable to cash, another asset. Now let's jump over to the other side of the equation and talk about liabilities and equity. So when we're talking about liabilities and equity, we're talking about what the business owes. So assets are talking about what the business owns, and liabilities and equity are about what the business owes. So when we're talking about liabilities, this is what a business owes to someone else. So we owe money to a supplier, or we owe money to a bank, or we owe money to a government taxing agency. So that is what we owe to third parties, somebody outside of our organization. But we also have a debt, a liability to the owners of the company. And if it's a single owner business, then this is what we owe to that person who has invested their time, money, blood, sweat, and tears into the business. If it is a business that has partners, we're looking at how much each partner has in worth in the business, that if we were to close the business today, we would be paying out to them in theory. If it is a business that is a corporation and it has many owners, then we're looking at what we owe to all of those different owners. So on the right-hand side of that accounting equation, we have what the business owes, whether it is to a third party like a vendor or a bank, or to the owners. So another way of stating this would be assets minus liabilities equals equity. And the easiest way to understand that would be if you own a house and you have a mortgage. So you own a house that you paid $200,000 for, you owe the bank $180,000, and so your equity is $20,000. So that's what we're talking about when we're talking about assets, liabilities, and equity. Now, within that liability section of our accounting equation, we have a variety of accounts that could be there. So the first one that we would expect to see very commonly would be accounts payable. So accounts payable is when you have bought something from a vendor and you're going to pay for whatever it is you bought, maybe it's inventory, you're going to pay that bill in 30 days. So that is accounts payable. You owe money to someone else. Other accounts that you would expect to see in liabilities that would be very common would be if you have a car loan on a company vehicle. So within our accounting equation, that would be a liability. It is money that we owe to a third party. So we would see that in our liabilities section as an account that would be called something like note payable big bank. You might also have something like sales tax payable. So you are collecting sales tax when you sell to a customer and you are holding that in trust for the revenue department of the state that you're collecting it for. You could also have payroll tax payable. Again, this is money that you owe to a third party, in this case, a government body of some sort. Now, on the equity side, we've got a few things going on here. So the first one would be that the owner of the business, whether it is a single person who owns it or it is a group of stockholders who have bought stock, those are investments into the business. So the owner says, I'm going to put in $50,000 of my money, or the stockholders say, we're going to buy 100 shares of stock each, and that money goes into the company. So these are owner investments. So that's part of what's going to be in your owner's equity type accounts. Now you would also see something called owner's draw or owner's withdrawals or dividends. And that would be a situation where the owner is actually taking money out of the business. So I put money in and now I'm going to take some of that money back out. So if it's a corporation that's paying dividends, that's what's happening there. They are reducing the equity by taking money out and giving it to the shareholders. If it's a business owner who has put money in, who is now taking money out, he or she is reducing their equity in the business because they're taking some of that money back out. So the business owes them less. The other thing that you will see within that equity section would be something called retained earnings. And what retained earnings is it is an accumulation of profits and losses over time. So when a business has a profit, the owner, whether it's a single owner or partners or shareholders, when there is a profit, their equity increases because they have now more value in the business. When a business has expenses that exceed their revenue, they have a loss. So a loss has the impact on the accounting equation of making equity less. Now, over time, you have profits and losses every month moving forward, and that all ends up in this account called retained earnings. And if it's a positive number, that's great. It means that the business value has increased. The owner's investment has earned a return. But if you have a lot of losses and you end up with retained earnings that are negative, it means that the investment is not paying off so well. Not good. So within that equity piece, we've got owner's investments, we've got owner's draws or dividends, and we've got retained earnings. So every time a transaction happens, it impacts at least two accounts within that accounting equation. Now, it could be all on the asset side, or it could be all within the liabilities, or all within the equity section, or it could be just between liabilities and equity. So all of those transactions, regardless of where they impact, it needs to come back to that equation. It has to equal. And there you have it. The accounting equation demystified. Be sure to check the description box for other videos that will help you to understand the basics of accounting. Until next time, keep it balanced. We'll talk to you soon. Sometimes the way we teach accounting in beginning accounting classes seems, at least to me, to be kind of, what's the correct accounting term? Downright weird. In this video, I'm going to take the weirdness out of beginning accounting for you. Welcome to Accounting How-To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Terrence, looking pretty buff there, big guy. Let's talk about accounting textbooks. I swear somewhere in your textbook you'll find a line that says, and someday we might even be able to use computers to do accounting. I'm not saying textbooks are behind the times. Okay, yes, that's what I'm saying. The way we teach accounting hasn't changed much since old Terrence was a hatchling. Aw, Terrence, looking adorable, buddy. Case in point, in the first 4 chapters of just about every textbook, we take you through all the steps to track accounting as done when I was a cub accountant 35 years ago. It's all manual. The good news is that it gives students a great appreciation for accounting software. Fortunately, for the subscribers and fans of this channel, I speak both the ancient language of manual accounting and that newfangled software language. I'm here to serve as your translator. In your first accounting class, most textbooks start you out learning how to analyze transactions by using a spreadsheet version of the accounting equation. We guide you through it, and then we never talk about it again. Then we guide you through analyzing transactions using something called T accounts. And then those T accounts are abandoned on the side of the road. So sad. And then we move on to analyzing transactions using journal entries. And that's where we land for the rest of accounting classes forever and ever. As I lie awake at night thinking about accounting, doesn't everyone? I had the realization that we never really explained that the 3 methods, spreadsheets, the T accounts, and the journal entries, are all giving us the same information. We're just expressing it differently. So I thought, hey, what if I could put together a list of transactions and walk my cool kids of accounting, that's you, through each of those methods so that they can see exactly how they compare. And, oh, by the way, it would be a huge help in doing homework for the first couple chapters of accounting class. So I did it. I put together 3 videos of accounting exercises so you can see the same transactions 3 different ways. You'll find the links to those videos in the description, of course. And then if you could please post in the comments your feedback as to whether or not you found this helpful. And if you did find it helpful, your feedback just might tempt me to do more homework helping accounting exercises. So until next time, stay balanced, my friends. In this video, I'm going to show you exactly how to conquer the spreadsheet that we teach in our first accounting class, our first chapter, our first week. By the time we're done with this, you are going to feel wicked smart, as we say in Maine. So let me walk you through this spreadsheet. So here on the first tab, we have the transactions that we talked about in the last video. And if you haven't watched that, I will link that down below. Then we're going to show here our chart of accounts. And again, if you haven't watched the chart of accounts video, I'll link that down below. But these are the accounts that we have that we can use in this new company that Joe Smith has started to track our transactions. So I've done a little cheating here for you because, I want to make sure you have all the right tools to do well in accounting class. So here we have our chart of accounts. These are the names of our accounts. I have added the account type to help you out here. And then I've also added the normal balance for those accounts. So this is what we have to choose from. We've got cash, accounts receivable, and supplies for our asset accounts. We've got accounts payable for our liability account. We've got Joe Smith Capital and Joe Smith Drawing for our equity account. And then for revenue, we've got fees earned, and then we've got rent, salaries, supplies, auto, and miscellaneous expense. So these will remain the same for all three of these methods that we're going to go through in these different videos. So here we're talking about the spreadsheet, and we're going to jump down here to this tab. And this is what the spreadsheet looks like for that first chapter of your first accounting class. So I have done some color coding to help you out. So here on the left-hand side of the accounting equation, and again, the link for the accounting equation video is in the description if you need it. And we have our assets on the left, and those asset accounts pulling directly from our chart of accounts. We've got cash, accounts receivable, and supplies. Cash, accounts receivable, and supplies. And then on the other side of our equation, we have our liabilities and our owner's equity. And we said that our liability account that we have for this particular example is accounts payable. And then our capital accounts for Joe Smith Capital and Joe Smith Drawing, the equity accounts. And then, as we talked about in the accounting equation video, when we're talking about owner's equity, it is impacted by revenues, making it go up, or expenses, making it go down. So we have expanded our accounting equation here to include our fees earned, which is our revenue account, and our various expenses, where we'll be subtracting those from our fees earned. That will give us our overall owner's equity number. So it's still our good old accounting equation, assets equal liabilities plus owner's equity. We've just expanded it to include these various accounts. So then what we want to do is we want to start working through our transactions so we can see how it works within this spreadsheet. So our first transaction, we're opening up our business account and we are depositing $55,000 from personal funds. So what are we getting? We are increasing our cash by $55,000 and we are increasing our equity by $55,000. Whoops. So is our accounting equation in balance? We are increasing cash on the left-hand side and we are increasing capital on the right-hand side. So we are in balance. We love that. Our second transaction, we purchased office supplies on account for $3,300. Are we paying for them now? We are not. We are buying them on account, which immediately tells me we have to pay for them later. So $3,300, we are increasing our liability, our accounts payable. And what are we getting for that? We are getting supplies. And remember I said that this is the supplies asset account, not the supplies expense account, which you see over here. So $3,300. So far, we are in balance. Everything is looking good, feeling good. And then the next transaction says that we are receiving cash. Okay, big clue right there. So we're receiving cash for fees earned. We're doing the thing that we do in our business that makes us revenue. And that amount is $18,300. So we're increasing our cash by $18,300 and we have revenue. Our fees earned is going up by $18,300. Again, we've got plus $18,300 on the left and plus $18,300 on the right. We're in balance. Doesn't that feel good? I love being in balance. The next thing that happens is that we're going to pay rent for $8,300. So how are we going to pay that? Well, pretty good chance we're going to pay it with money. So we are reducing our cash balance by $8,300. And the other side of that will be our rent expense. And we said that when we have an expense, it reduces owner's equity. So in this spreadsheet version, we will be doing minus $8,300 because we're reducing our equity. So now we have minus 8,300 on the left, minus 8,300 on the right. We're still feeling good. We're still feeling like we're in balance. In the next transaction, we're going to pay creditors on account. So let's talk about that. Who do we have for a creditor? Who do we owe money to? Where's our liability? Well, the only liability that we have is this $3,300 in accounts payable for our office supplies vendor. So we're going to be paying part of that bill. We're not paying all of it. We're paying part of it. So what do we need to do with accounts payable? Do we still owe $3,300? We don't, because we just paid $2,290 of it. And where's that money going to come from? Obviously, it's got to come from our checking account. So we're reducing our cash. So in the next transaction, now we're going to bill our customers. So two things going on there. We're not getting paid right now. We are going to bill our customers and we're going to get paid later. So that to me says we must now have an accounts receivable. So we're going to increase our accounts receivable by $30,800. And the other side of that is that we have earned some revenue. So we've done the thing that we do in order to make money. So we're going to increase our fees earned by $30,800. I can't wait to see what happens next. This is so exciting. So the next thing that's going to happen is we're going to pay some expenses. So whenever you see a transaction that says paid, you can guarantee that it's going to come out of your checking account. So in this transaction, we're actually paying two different expenses. So we're paying auto expenses and we're paying miscellaneous expenses. So our auto expense is going to be minus $1,380, and our miscellaneous expense is going to be minus $1,800. All right, so then what happens over here on the cash side? So we're going to combine those two expenses. And let's see, 1,380 and 1,800 is 3,180, and as we know, we are subtracting that. So we've combined those two expenses, we've put them in their individual accounts, and we've combined the amount of our cash. Now you could 100% do those as one line apiece and have your 1,380 coming out of cash and your 1,800 coming out of cash, and then your 1,800 being down here in the next line. You could totally do that. And then the next thing that happens is we're going to pay salaries. So we're going to pay our employees, and we're going to pay them $7,300 from our cash account because, you know, they're not going to take promises. They want their money. And then we're going to subtract that from our salaries expense. We're reducing equity. And then comes our weird little tricky supplies expense transaction. So what we're being told is that we have used up $2,050 of our supplies. So right now our supplies balance is $3,300, but we've used up $2,250 of that. So we want to subtract $2,250 from our supplies balance. And what the other side of that's going to be is an expense. So we've used up our asset. It's become an expense. So we're going to subtract that from our equity under supplies expense. And then our final transaction, Joe Smith is going to take money out of his business. He's going to take $13,800 out of the business, and the effect on his equity is that we are reducing his equity. So $13,800 to reduce his equity. So those are your transactions. And now comes the magic part. Are you ready for this? So now here are our column totals for all of our accounts. And I'm just going to bold those to make them pretty. So what we want to do is we want to determine if we are still in balance, because everything has to balance. You know, I keep telling you, stay in balance. Well, this is what I'm talking about here. So we want to make sure that our assets equal our liabilities plus our equity. So all we're going to do is we are going to total up our assets, and we're going to total up the right side columns here. And look at that, we are in balance. So now we have recorded all of our transactions for the month of June. We've debited and credited and made sure that those were equal as we went down line by line. We totaled up our account totals, and then we checked to make sure that our assets equal our liabilities plus our equity. If you get to this place and your assets do not equal your liabilities and your equity, then go back and go through each one of those transactions and make sure that you're getting each line in balance. So that's the key. If each line is in balance, when you get to the end, you will be in balance overall. So make sure that, for example, if you've got a minus 83 on the left-hand side, you've got a minus 83 on the right-hand side. That's usually the part where people get tripped up. So there you have it. There is the kind of odd, and we'll never see it again, but we did it, Chapter 1 spreadsheet version of tracking and analyzing transactions. So join me again for the next video where we will talk about how to do the same thing but using T accounts, which will get introduced to you next in your accounting. Until next time, stay balanced, right? You're starting to get that. I know. Yeah, it's great. All right. Peace out. What are these weird things called T accounts? I mean, who makes this stuff up? Well, I'm going to break it all down for you in this video, and then I'm going to give you another resource that will not only help you understand T accounts better, but help you get an A on your accounting homework. Stay tuned. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence the T Account Rex. So let's dig right in. First of all, what is a T account? Well, a T account is a simplified version of an account record. So think about it in these terms. Think about your checkbook register, and then think about scribbling down some numbers on a napkin. Well, a T account is a simplified version of your checkbook register where we're going to scribble things down on a napkin. So it's just a simplified version to help us kind of track some things. And the reason we call it a T account is because it's shaped like a T, and accountants are really creative like that. So how does a T account work? What we're doing is we're taking accounts from our chart of accounts, and of course the link to that video will be in the description. So we're taking those accounts from our chart of accounts, things like cash, accounts receivable, supplies expense, and we're just going to use this simplified version to kind of map out what's going on with transactions that impact those accounts. So every account in your chart of accounts would have a corresponding T account. And here's what that looks like. We're simply going to have the account name on the top line, and then the divider between the two is the debit credit line, okay? It's to keep your debits and your credits from fighting with each other. So we want to make sure that we have your debits on the left, your credits on the right. So what we're going to use T accounts for is to track transactions, just like we would in a journal entry or in a spreadsheet. We're just doing it in this weird thing called a T account. Now, before you can understand how T accounts work, you've got to understand normal balances of accounts and debit and credit rules. Okay? Obviously, there'll be a video for that, so you can check that out. But let me just give you the brief rundown. So different account types have different rules for increasing and decreasing those accounts. These are normal balances for those particular accounts. So, assets, expenses, and owner's withdrawals or dividends have a normal debit balance. So, if an account has a normal debit balance, we increase that account by debiting it, and we decrease it by crediting it. So, assets, expenses, dividends, owner's withdrawals have a normal debit balance. And then liabilities, revenue, and equity or capital accounts have a normal credit balance. So if it has a normal credit balance, we increase it by crediting it and we decrease it by debiting it. So my way of remembering those accounts is to say, after eating dinner, let's read ebooks. AED, assets, expenses, debits, after eating dinner. Let's read ebooks, liabilities, revenue, equity or capital. The normal balance is a credit. So every time we're increasing or decreasing an account, because there's been a transaction, we're going to increase or decrease those accounts based on those normal balances. So let's look at some quick examples. So example number 1, we have an expense of $10. And as far as we're concerned, it doesn't really matter what the expense is called. It could be anything. It could be office supplies expense. It could be salaries expense. For the purposes of understanding T accounts, we're just going to call it expense. Keep it simple. So we have an expense of some kind of $10, and we're going to pay cash for this. We're not going to do accounts payable where we're going to pay it later. We're going to straight up pay cash. So what are the accounts being impacted? We know cash is being impacted and this expense account is being impacted. So let's talk about those two accounts. We have an asset and we have an expense. Those have normal debit balances. So they increase on the debit side, decrease on the credit side. So let's talk about our expense. Our expense is increasing. We have incurred an expense, so our expenses have gone up. An expense has a normal balance that is a debit, and we want to increase it, so we're going to debit this expense account by $10. Debits go on the left, credits go on the right. Debit and credit means simply left and right for the purposes of accounting. So we're going to increase our expenses by $10 in our T account. And what's happening with our cash? Our cash is decreasing, right? So it has a normal debit balance. We increase it on the debit side, we decrease it on the credit side. So we're going to decrease our cash by crediting it $10 in our T account. Transaction number 2, we have $20 in revenue. We have sold something to our customers for $20. And let's assume our customer is going to pay us cash. It's not accounts receivable where we're going to get paid later. We're getting cash. 2 accounts being impacted. A revenue account, and again, it doesn't matter what you call your revenue account. For the purposes of this exercise, revenue is revenue is revenue. So we said that revenue has a normal credit balance. And what's happening with our revenue? Is it increasing or decreasing? Well, it's increasing. So as a normal credit balance, we're going to increase it by crediting it for $20. What else is happening? We said we're getting paid in cash. So what's happening with cash? Cash is increasing. So if we have a normal debit balance for an account, we're going to increase it by debiting it, left-hand side of the account. So we're going to increase our cash by $20 by debiting it in our T account. Transaction number 3. Let's say our owner makes an investment in the business. That investment is going to be $5. So what are we getting in the business? We are getting $5 in cash, right? The owner is putting money into the business. So we're going to want to increase our cash account. And how do we increase an asset? We increase it by debiting it. So we're going to put that $5 into our cash account. Now, every time you're dealing with debits and credits, there's got to be at least one of each. There can be many more than that, but there's got to be at least one of each. So what is the other side of this transaction going to be? Well, the owner is making an investment. So the owner now has equity in the business. So we're looking for an equity account of some kind. And again, for the purposes of this exercise, we want to keep it very simple. We're just going to call it equity. We would normally call it something like Joe Smith equity or Joe Smith capital. But in this case, we're just going to call it equity to keep it simple. So what's happening with our equity account? The business now owes him that money, so he has created value for himself in the company. So capital equity accounts have normal credit balances, so we want to increase it by crediting it. We're increasing his equity in the business. So we're going to credit our equity account by $5. Now let's say the owner decides that he wants to take some money out of the business. So he's going to take $2 back out of the business. So what's happening with our cash account? Our cash account is decreasing, right? Has a normal debit balance, so we're going to decrease it by crediting it $2. Now let's talk about his equity. He's reducing his equity in the business. He put in $5, now he's taking 2 back out. So we could use his equity account and debit it to decrease it. But we want to keep track of how much he's put in and how much he's taken out separately. So we set up this other account called dividends or owner's draw or owner's withdrawals to track what the business owner has taken out of the business. Or if it's a business that sells stock, then we want to keep track of the dividends that we have paid out to the stockholders. So we keep that in a separate account. So we said that dividends has a normal debit balance. So we're going to increase the amount of dividends or owner's draw by debiting it $2. So we've debited our dividend account and we've credited our cash account. So those are like some of the simple basic accounts that we would be looking at. When we start adding on complexity, like adding a bunch of different expenses or some different asset accounts like accounts receivable or some additional things like liabilities like accounts payable, we just multiply the number of T accounts that we have. But those basic transactions are always going to work the same. You're debiting and crediting the same things, but it may be to a more specific account name like supplies expense. So once we've done all of our transactions in our T accounts, the next step is to get a balance for those accounts. Now, when you're doing balances on your T accounts, you would expect to see that balance end up where a normal balance should be for that account. So if it's a cash account, for example, cash is an asset. Assets have normal debit balances. You would expect to see the balance of that account be a debit balance. So when you're totaling up your accounts, you're adding up your debits, you're adding up your credits, and you're finding the difference between the two. So if your debits are greater than your credits, it's going to go on the debit side. If your credits are greater than your debits, it's going to go on the credit side. You don't want to have balances on both of those columns. You want the difference between the two, and it needs to go either on the debit side or the credit side, depending on the account. Once we have those totals, then we take them and we put them into what's called a trial balance. And the purpose of a trial balance is to make sure that you have debited and credited equally. We said every debit has to have a credit. At least 2 accounts are going to be impacted in every transaction because of the accounting equation. So we want to make sure that our debits equal our credits. That's the only job of the trial balance. Do your debits equal your credits? If they don't, it means that something has been misposted and you go back and go through each transaction to figure out which one you messed up on. I like to keep it real. There are things that we teach in accounting class that we would never do when we're actually doing accounting. Now, is T accounts one of those things? We actually use T accounts in real life. If I have a transaction and I'm trying to figure out like what happened with this, what went up, what went down, I will absolutely grab that napkin and sketch out some T accounts so that I can sort through all of the accounts that are impacted. And of course, when you've been doing accounting for a while, it's not going to be like a day-to-day transaction that you need to do that for. It's going to be something that's more complicated. But I absolutely, after 35 years in accounting, will still grab a piece of paper and draw some T accounts for those complicated transactions. Now, your next steps would be to go more in depth on how to analyze transactions using T accounts. Go to the Analyzing Transactions T accounts video in the description, and you'll be able to get into the more specific transactions that you typically see in accounting class and on your accounting homework. So you'll be able to work through all of those typical transactions. So when it comes time to do your homework and your test, you are going to be a T account rock star, okay? So until next time, stay balanced, my friends. Once upon a time, there was this brand new shiny accountant, and she went to work for this grizzled old accountant who'd been in the business for decades. And every day she would watch this man go to his desk, open up the top left-hand drawer, pull out a piece of paper, look at it, he'd nod, he'd fold the piece of paper back up, put it in the drawer, lock it, and they'd go on with their day. She watched this happen morning after morning after morning, 7 days a week, because that's how much accountants work. And finally, one day, the old accountant decided he would retire and sell her his practice. Well, finally, she was going to be able to find out what was in that desk drawer. So the very first morning, with the keys in hand, she walks over to the desk and ... Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. Very funny, Terrence. And now, back to the joke. So she goes over to this desk, right? And she's so excited. She's finally going to figure out what the big secret is. And of course, it was one of those old metal army surplus desks, because accountants are notoriously cheap. But she goes over to the desk and she unlocks the drawer and she pulls it open. She gets that little piece of paper out. She looks at it and she reads it. And it says, debits on the left, credits on the right. Now, let me explain why that's funny. See, the fundamental rules of accounting are that debits are on the left and credits are on the right. I mean, this is like a building block of accounting. You learn it the first week or two of accounting one. It's funny. You'll get it later. It's okay. So today we want to talk about debits and credits, because this is something that causes a lot of confusion for people. So in accounting, all debit means is it's the left-hand side of an account, and credit is the right-hand side of an account. That's all it means. Debits on the left, credits on the right. The reason that there is confusion here is because of banks, right? You think about a debit card as being something that reduces your bank balance, right? So banks are not keeping track of your money. Banks are keeping track of their money, some of which they owe to you. So when banks talk about debits and credits, it is not what we're talking about here, because they're tracking something entirely different from what we're tracking. They're on the opposite side of the transaction. When we talk debits and credits in accounting, all we're saying is debits on the left, credits on the right. Debits are the left-hand side of an account and credits are the right-hand side of an account. That's all it means. Now, those debits and credits are how we communicate with our accounting system. It's how we tell it what to do, right? We're in charge of our accounting. We're the boss of it. So our debits and credits are being used in conjunction with our normal balances in order to tell the account whether we want to increase it or decrease it. And don't get caught up in the idea that debit means you're increasing and credit means you're decreasing. That is not true, my friends. Debit simply means it's the left-hand side of the account and credits are the right-hand side of the account. So when you combine this video about debits and credits with my accounting equation video and my normal balances video, which I'll link in the description, you are well on your way to becoming a grizzled accountant like me who laughs at silly accounting jokes. That's your future. You're welcome. So until next time, stay balanced, my friends. Categories. Names of chart of accounts. Oh, hello. Growing up ever so long ago, we played a clapping game on the schoolyard at recess. We had to pick a category and then name things within that category. So in this video, we are breaking down the categories that are the building blocks of our accounting system. As always, clapping is optional. I mean, if you need applause, don't become an accountant. Seriously, no one claps for accountants. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. It's hard to find good help. Let's jump right in. Now, accounting is all about keeping things organized. It's part of the beauty of accounting. Once you understand that structure, your accounting life becomes so much easier. When we talk about structure in accounting, we're talking about what's called a chart of accounts. That chart of accounts lists every different kind of account that we're going to use to track our day-to-day transactions. That chart of accounts breaks accounts into categories or types of accounts. And we start with the 5 basic account types: assets, liabilities, equity, revenue, and expenses. And if you've watched my accounting equation demystified video, these will seem strangely familiar to you. And I'll link that video in the description if you haven't seen it yet. Now, within each of those categories, individual accounts are used to collect our transactions. And you can think of those accounts as buckets that collect our information. So if we pay the electric bill, we take money out of our cash bucket and we put our electric bill in a bucket we call utilities expense. Then at the end of the month, we'll add up each one of our buckets and see how we made out for the month. What's in our cash bucket? How much is in each of our expense buckets? Now, different types of businesses need different types of buckets. So a service business, where you're trading time for money, has a simpler chart of accounts. You need fewer accounts. Then a merchandising business, where you're trading purchased merchandise for money, or a manufacturing business where you're trading manufactured goods for money. Now, a merchandising business would need an asset account for inventory and an expense account for cost of merchandise, where you're buying merchandise to resell it to your customers. A manufacturing business would need accounts for inventory for different things. It would need a raw materials inventory account, a work in process inventory account, and a finished goods inventory account, and an expense account for cost of goods, where you're buying raw materials to turn them into products that you will sell. Now, when a chart of accounts is set up for a business, you can add a numbering system. This isn't required, but it does help in keeping things organized and efficient. And you know I like things to be organized and efficient, so I usually will use account numbers. So if a number system is used, it follows the order of the account types. For example, asset accounts would start with the number 1, liabilities 2, equity 3, revenue 4, expenses and 5. So every account within those categories would be numbered something like 1010 or 1020 or 4010. This is just a way to help us to be more efficient with the way that we do things and to stay more organized. Now, in the case of a merchandising or manufacturing business, we would add a section in the expenses to track the cost of merchandise or the cost of goods. So in that case, the first four categories would remain the same as far as the numbering goes, but we would add another section. Now, since most of us, other than certain dinosaurs, are using a software program to track our accounting. And because of that, we have some additional points to consider. Because of the way our software is set up, it uses certain modules for reporting and function. So for example, if you have an asset that is a bank account, in accounting class, we would call this account cash for simplicity. But that account in our software would be named something like Big Bank Checking. And the account type assigned to it would be bank rather than asset. So this tells our software that this is a bank account that we will need to reconcile. And this opens up the magical door to the bank reconciliation module. Whew, love that bank reconciliation module. Makes life so much easier. Now, if we sell to our customers on credit or on account, meaning they will pay us later, in accounting class, we would categorize this as an asset called accounts receivable. In our software, we would call this account type accounts receivable rather than asset. And this tells our software that we will want to be able to invoice our customers, receive payments from our customers, and run reports showing what our customers owe us. If we buy from vendors on credit or on account, in accounting class, we would call this a liability named accounts payable. In our software, we would assign this as an account type called accounts payable rather than liability. And this tells our software that we will be using this to track and pay our bills and to run reports that show us how much we owe to different vendors. The account types don't change. A bank account is still an asset. Accounts payable is still a liability. But within the software, we're accessing some important features that will help make life easier by referring to some accounts by a specific type of asset or liability within the software. Now, how do you set up a chart of accounts? Accounting software makes this very simple. It provides a preset group of accounts based on the type of business. So if you tell the software that you run a hair salon, it will give you a typical chart of accounts for a hair salon. If you tell it you have a retail store, it will give you a preset chart of accounts for a retail store. If you tell it you run a factory, it will give you preset chart of accounts for a factory. Now you're always free to customize the accounts to add on or delete or make inactive or rename them. You can always also group expense types together by using sub-accounts. For example, you can group revenue accounts or group payroll expenses or group occupancy expenses. So you can track as much or as little detail as makes sense for your business. Now, the way that we classify accounts is extremely important because it determines where those accounts show up on our financial statements. So if you set up an account called sales and you categorize it as a revenue account, it will turn up just as it should on your income statement. But if you misclassify a revenue account as an asset, for example, it will turn up on your balance sheet. And that would be awkward. As awkward as a dinosaur in a henhouse. Nobody wants that. So there you have it. Everything you ever wanted to know about the chart of accounts but were afraid to ask. Be sure to check out the description for more fundamentals of accounting videos. Until next time, stay balanced, my friends. In this video, we are going to figure out how to use T accounts in order to track transactions in accounting. Now, T accounts. Now, I explained T accounts in my T accounts video, which I'll link down below. But the basic concept is that we're using kind of a simplified version of accounts here that are in the shape of a T and therefore called T accounts. And as you know, Terrence thinks T accounts are named after him. We'll let him think that. But by the time we're done, you are going to be able to T account with the best of them. So let's jump right into our sample transactions. We're using them in the spreadsheet version and we're using them in the journal entry version. This is our T accounts version. Now I want to introduce also in this lesson the idea of a trial balance. When we did our spreadsheet version, we checked this based on our extended accounting equation, assets equal liabilities plus equity. In this case, we're going to use this handy dandy thing called a trial balance, and it's going to do the same thing for us, but in a much easier format to follow. So here we go. First transaction. Joe Smith opens his business June 1st. He is in the property management business. And the first thing that he does is he puts $55,000 into the business as an investment. And this is going into our new business checking account. So what's going on with this transaction? We are increasing the cash in the business and we are increasing Joe Smith's equity. So how are we going to do that in a T account? We're going to come over here, debits on the left, credits on the right. We want to increase our cash, which is an asset, has a normal debit balance. So we are going to debit cash $55,000. Boom. And we want to increase Joe Smith's equity in the business. We're going to do that by crediting his capital account. This is an equity account, has a normal credit balance. So we're going to increase it on the credit side. Boom, transaction number 1 done. So then what happens? We are going to purchase office supplies on account for $3,300. So what does that mean? What are we getting? We are getting supplies. And remember, this is our supplies asset account, not our supplies expense account, okay? So here's our asset, here's our expense. Do not get those confused. Our supplies asset account acts like an inventory account. So what are we getting? We are getting $3,300 in supplies, our asset. So there we go. We are debiting supplies. It's an asset account, so we debit it by increasing it on the left-hand side, on the debit side. So supplies, the asset is an asset account, has a normal balance that is a debit, and so we're going to increase it by debiting it. So there we go. Left-hand side of the account, debits on the left, credits on the right. And then what is the other side of this transaction? Have we paid for these supplies yet? We have not. And we know that because it says we bought them on account. On account, or we ain't paid for them yet. So we now have a liability. There's money that we owe to someone else. So we are going to go over to our accounts payable account. Accounts payable is a liability, has a normal credit balance, so we increase it on the credit side. So now we're saying we have a liability, we owe this money to somebody else. So there we go with that transaction. What happens next? We received cash from fees earned from managing rental property, $18,300. So the thing that we do in our business to make money is we sell our property management services. So $18,300, we're going to come over to our fees earned revenue account. Revenue has a normal credit balance, so we're going to increase it on the credit side for $18,300. Now, have we gotten paid for this? In this case, it says very specifically, received cash. So yes, we did get paid. So we want to come over here to our cash account and we want to increase it. It's a debit balance normally. We're going to increase it on the debit side for $18,300. Oh, look at us just debiting and crediting like madmen and women. So then we're going to pay rent, $8,300. Well, where is this rent money going to come from? It's going to come from our cash account. So because this is an asset and we want to reduce it, we're going to go to the credit side. So a credit reduces an asset. And we're going to say we want to reduce our cash account by $8,300. Now you will notice we do not use a minus sign here. We do not use a minus sign or a plus sign anywhere within our T accounts because this already means minus. So when you put a credit in your cash T account, you are saying we are subtracting this. We are reducing our balance. So I don't want to see any minus signs turning up in your T accounts because I will point at you and laugh. Not really, but okay, if it helps, that's what I'm doing. Don't do it. Just don't do it. All right, so we are paying out cash. What is the other side of this transaction? Well, we're paying rent expense, right? So we want to come over to our rent expense T account and we are increasing our rent expense. So we are going to debit that because an expense has a normal debit balance. So we are going to increase it by debiting it for $8,300. What happens next? Well, we're going to pay creditors on account for $22.90. So what's going on here? We have one creditor that we know of, the only transaction that we've had. So we can assume that we're paying this office supply vendor. We're not paying the whole bill because we owe them $3,300. We're only paying $22.90. So when we're done with this transaction, we will no longer owe $3,300. So we are going to record what we are paying, which is $22.90. Because accounts payable is a liability, it has a normal credit balance. So if we want to decrease it, we're going to debit it. Okay? And then what's the other side of this transaction going to be? We paid cash in order to pay our bill. That's usually the way it works. So we want to reduce our cash balance by $22.90. We do that by crediting it. And then something exciting happens. We're actually going to make some revenue again. Don't we love it when we make revenue? It's great. So we billed our customers for fees earned for $30,800. So we have revenue, normal credit balance. We're going to increase it on the credit side, so $30,800. And then did we get paid for this yet? We did not. It says we billed our customers. Didn't say we got paid. So that means that our customers are going to pay us on account. They're going to pay us later. So we want to come over here to our accounts receivable asset account and record that we are going to get paid later on $30,800 by our customers. The next thing that happens is we're going to pay some more expenses. Our auto expense and miscellaneous expense. Our auto expense is $1,380. It is an expense, has a normal debit balance, so we're going to increase it on the debit side. And our miscellaneous expense, we're going to do the same thing. We're going to increase that by debiting it. So where did that money come from? Well, it came from our cash account. So now what we want to do, and you can do this two ways. You can either do this, record your $1,380 and record your $1,800, or you can combine that and just make it one figure. In this case, I'm going to just leave it this way because if we do have a mistake somewhere, it will be easier to track that. So I can look at this and say, yep, we took care of that $1,380. Here's the other side of it. Here's my $1,800. There's the other side of it. So I'm going to leave it that way just in case we run into any problems. And then next, we're going to pay our salaries. So our salaries expense is going to increase by $7,300. and our cash is going to decrease by $7,300, okay? So all of our cash decreases are on the credit side, and this is based on our normal balances. And now comes the tricky little one that they like to throw in here, just to see if they can trip you up, okay? So we bought $3,300 of supplies. So the next transaction that we're doing, it says that we determined that the cost of supplies on hand was $1,250. Therefore, the cost of supplies used was $2,050. So here's what's going on. This is what's actually called an adjusting entry, which we don't even get to until chapter 3. So they're kind of just sort of sneakily introducing this idea. So we have in this supplies asset account, as I said, it works as an inventory account, $3,300 in supplies. But we don't really have $3,300 in supplies anymore because we've used up a bunch of them. So according to this transaction, we are saying that the cost of supplies on hand is $1,250. So when we are done with this transaction, the balance in our supplies account should be what's left, what's on hand, $1,250. So how do you get from $3,300 to $1,250? Well, we're going to reduce it by the cost of supplies used, $2,050, which is the difference between what we started out with and what we ended up with. So we are reducing our supplies by this amount. Now, what's the other side of that going to be? Well, when you use up an asset, like an inventory account or supplies, we are going to turn that into an expense. So as you use up an asset like supplies or inventory, it becomes an expense. So we're going to move that to the corresponding expense account called supplies expense. So we're going to increase that by $2,050. And what this is saying is that this is what we actually used. So when we do our balances on this supplies account, we will magically, if I've done my math right, end up at $1,250 for a balance. And then the final transaction that we're doing for this month is we have Joe Smith withdrawing cash for personal use of $13,800. So we know right away that our cash is reducing. So we're going to go over here and credit that. And then we're going to come over here to our drawing account. And we want to debit this drawing account. A drawing account, withdrawals, dividends, has a normal debit balance, and we are going to increase that. So we're coming here on our debit side. And this is a good time to talk about how these two accounts work together. So they're both equity accounts, right? So if we were to take this $13,800 and we were to put it over here, the net effect will be that we are reducing Joe's capital account overall by $13,800. But what we're doing instead is we want to keep track of how much money Joe has taken out of the business. So here's what he's put into the business, and here's what he's taken out. So this will appear as two different lines on our financial statements. The effect is still the same. It's still owner investments minus owner's draw, giving us a net owner's investment number. But we want to keep track of it over here. It has the same effect on capital as if we were to put it over here as a debit. It's reducing the amount of capital that Joe Smith has in his business. But we want to keep track of it separately. That's why we do that. So now we have done all of our transactions, and it's time for us to figure out our balances. So I'm going to start here with our accounts receivable. So our balance is $30,800. That's pretty simple to do since there's only one transaction. Now let's talk about our supplies account. We have a debit and we have a credit. So when we're doing a balance for these accounts, we're going to take our debits and we're going to subtract our credits. So in this case, when we use the magic of Excel to figure this out, we're going to take this minus this, and it's going to give us a balance of, wait for it, $12.50. Oh my gosh, it worked! This is great! So you don't want to put a balance on both sides. You want only this balance on one side. And this is a debit balance. The debits are greater than the credits, okay? Now let's come over here to our accounts payable. Accounts payable has a normal credit balance. So you would expect to see your balance on the credit side. If it's on the debit side, that is a clue that there may be a problem. There may not be a problem, but there may be a problem. So let's see what happens when we take our credits minus our debits. Whew, this is exciting. Don't you just love watching other people do math? It's so fun. All right, so that gives us an accounts payable balance of $1,010. This is what we still owe to our vendor. Here we're going to take our $55,000. We're just going to bring it down, our $13,800, because we only have one transaction in those accounts. And then we are going to add up our revenue. And again, it has a normal credit balance. All of our transactions are on the credit side. And same thing with our expenses. We're just going to bring those numbers down because there's only one transaction. It helps if you can type. And 1380 and 1800. Okay, so that's all of our balances except for this one. And I left this one for last. So cash is the account that's going to have the most activity in it. And so we got to make sure that we get all of our debit transactions minus all of our credit transactions to get to our cash balance. You would be expecting to see a debit balance because that is the normal balance for a cash account. It means you didn't spend all of your money. You could have a credit balance in this account if you outspend what you bring into your account. You know, you're basically overdrawn. But normally you're going to see this end up as a debit balance. So we're going to do a little adding, we're going to do a little subtracting, and hopefully we end up with a balance that makes sense. So now what we're going to do in order to check to make sure that we have debited and credited in equal amounts is we're going to come over here to this trial balance. And all the trial balance is doing is saying, let's look at what the balances are in these accounts and make sure that we have debited and credited appropriately. Now, it's not going to tell us whether we entered things in the wrong account. If we put our miscellaneous expense in our salaries expense account, it's not going to catch that error. What it's only looking at is, do our debits equal our credits? Because then we know that our accounting equation is in balance. So if it is a debit balance, we enter it on the left-hand side. And then our accounts receivable, $30,800. Our supplies is now $12.50. Our accounts payable has a credit balance of $10.10. Goes over on the right-hand side. Our capital is $55,000. And then we want to jump back to the debit side for our drawing account. Our fees earned is a credit balance. And then our expenses are debit balances. 7,300, 2050, 1380, carry the 1, take out the trash, and there we go. So we are in balance. Isn't that awesome? Isn't that a great feeling? Oh, so great. So there you have it. We have walked through our transactions using T accounts. And again, this spreadsheet will be available for you to download it. It's in the description. And it's going to include the transactions, the chart of accounts that we're using for these transactions, and then our 3 different ways of doing this, our spreadsheet version, our T accounts, and our journal entries. So until next time, stay balanced, my friends. So listen, I know that sometimes the world can seem topsy-turvy and out of control. And that is why we need accounting, because accounting is always in control. Accountants are always in control, at least of their accounting system. So in a time of trouble and strife, I always like to come back to a really important accounting concept, and that is normal balances. Welcome to Accounting How-To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. Your joke's getting a little old, Terrence. Maybe you want to freshen it up a little bit. Okay, buddy? Great, thanks. So in talking about normal balances, which are one of those key points of accounting that we all need to understand in order to either do well in accounting class or to practice accounting in the real world, whether as a business owner or bookkeeper or accountant, we need to come back to our accounting equation because that is the base of everything. And the accounting equation is assets equal liabilities plus equity. That is the basis of everything that we do in accounting. So to get more in depth on the accounting equation, you can check out the accounting equation Demystified video, which I'll link in the description. But as a refresher, assets are things that a business owns. Liabilities and equity are what a business owes. So liabilities are owed to a third party like a bank or a credit card or a vendor. Equity is owed to the business owners or the stockholders, right? Because they have invested money into this business and we owe them that money. Now, I want to talk specifically about this owner's equity part of this because this is the key to understanding normal balances. Owner's equity is made up of the owner putting money into the business, whether as a sole proprietor or as a stockholder where you're buying stock in a business. So you're giving the business money. So it is an owner investment. Now, if you as an owner take money out of the business in the form of an owner's withdrawal or dividends, then that is going to reduce your owner's equity. Okay, so owner's investments minus owner's withdrawals or dividends is one portion of our owner's equity picture. Now, the other side of that is that we are not in the business of not making money, right? We want to actually make profits in this business. And when we have a profit in a business, it increases the owner's equity, right? Part of that money belongs to the owner. So those profits and losses are going to increase or decrease owner's equity. So profits increase owner's equity and losses decrease owner's equity. And we have an account where we keep track of all of those profits and losses, and we call that account retained earnings. So now we have, as part of our owner's equity, we've got owner's investments, less owner's withdrawals, and then we're going to add or subtract profits and losses. So if we look at owner's equity as those two different pieces, we've got owner's investments minus their withdrawals or dividends. So you can consider that to be the owner's net investment. They put in $10,000, they took out $2,000, their net investment is $8,000. And then on the other side of that, we said that profits and losses increase or decrease the owner's equity. And how do we come up with profits and losses? We're going to take our revenue minus our expenses. So if revenue is $10,000 and expenses is $5,000, we have a profit of $5,000, which increases our owner's equity. If our expenses are higher than our revenue, then we have a loss and we are decreasing our owner's equity. So then we can look at this accounting equation on the owner's equity piece of it. We can add on to it. So we've got owner's investments minus withdrawals or dividends plus revenue minus expenses. It's still our old friend, the accounting equation. We're just kind of spelling out the details a little bit more. So here's what that looks like. We've got assets equal liabilities plus owner's equity. If we expand that out, we now have assets equal liabilities plus owner's investment minus dividends plus revenue minus expenses. And this is the part where your mind is maybe going to be blown, because it was that for me, okay? And to be honest, I was like today years old when I figured this out. You ready for this? When we're talking about normal balances, here's the way that's going to work. So over here on the left-hand side, we have our assets. And then if we jump over to the right-hand side of the equation, we have two items that decrease owner's equity. We have dividends and we have expenses. So we said that owner's investments and revenue increase owner's equity, and dividends and expenses decrease owner's equity. So when we're talking about normal balances, assets, dividends, and expenses work the same. Liabilities, revenue, and equity work the same. So when we group those together, we end up with something called normal debit balances and normal credit balances. And as a reminder, all debit means is the left-hand side of the account, and credit means the right-hand side of the account. Debit's on the left, credit's on the right. So normal balances for assets, dividends, and expenses are debit balances. Normal balances for liabilities, revenue, and equity are credit balances. Now stick with me, because I'm going to show you an easy way to remember this. And I'm also going to give you in the description a link where you can download a handy little cheat sheet so you can remember this. So here we go. We have our normal balances for assets, expenses, dividends. Our normal balances are a debit. For liabilities, revenue, equity, our normal balance is a credit. So what that means is if we want to increase an asset account, we're going to debit it. If we want to decrease an asset account, we're going to credit it. The same thing with the expenses and dividends. If we want to increase those accounts, we're going to debit them. If we want to decrease, we're going to credit them. And then liabilities, revenue, and equity, if we want to increase those accounts, we're going to credit them. If we want to decrease them, we're going to debit them. I said I'd provide you with an easy way to remember this. Here's what I want you to remember. After eating dinner, let's read ebooks. Accounts with debit balances after eating dinner, assets, expenses, dividends. Let's read ebooks, liabilities, revenue, equity. So after eating dinner, have normal debit balances. Let's read ebooks, have normal credit balances. So now that we have that little bit of information, we're going to actually take that and we're going to apply it. Are you ready for this? We're going to do some actual journal entries to see how this works out. Your very first journal entries with me. So here we go. Here are 3 sample journal entries. And you'll see the D and the C, that's your debit and your credit. Debit is left, credit is right. So in the first journal entry, you sell to a customer and they pay you in cash. So what do we have going on here? We have revenue. We sold to our customer and we are getting cash for that. They're paying us right now. So we are going to increase our cash account. Cash is an asset. An asset has a normal debit balance after eating dinner. And so we want to increase that account. We're going to debit it by $100. Revenue has a normal credit balance. Let's read ebooks. So revenue, we increase on the credit side. So what we've done here is we have increased our cash account and we have increased our revenue account. Stay with me. We have more to come. So now let's say we pay our electric bill. It's $50. So we have an expense called utilities expense and we're paying cash. So what's going on here? We have an expense account. We want to increase that expense account. Expenses have a debit balance. So we increase them on the debit side, and we are reducing our cash because we're paying our bills. So when you want to reduce an account that has a normal debit balance, you credit it. So we are increasing our expenses by $50 by debiting it, and we are decreasing our cash by $50 with a credit. Now let's say our business owner wants to take some money out of the business. So we said that an owner's withdrawal or dividend is going to be a debit balance normally. So we're going to increase that on the debit side. And we are taking cash out of the business. Cash is an asset. When we want to reduce it, we're going to credit it. So we're going to do a journal entry that says debit owner's draw $5 and credit cash by $5. Now, once you do all of these journal entries over a month, those entries get posted to accounts where we add everything up, and then we use that information to create our financial reports. So the rules of debit and credit all come back to this concept of tracking things within the accounting equation. And then we've got accounts that have normal debit balances, assets, dividends, expenses. And we've got accounts that have normal credit balances, liabilities, revenue, equity. And the way that we increase and decrease those is based on those normal balances. So you increase a normal debit balance by debiting it, and you increase a normal credit balance by crediting it. Now, if you pair this video with the debit and credit video and the accounting equation video, and then you add in the journal entry video, you're going to have a really good foundation in accounting. So there you have it, an explanation of normal balances. And the only time I really recommend being normal is with normal balances in accounting. The rest of the time it's overrated. So until next time, stay in balance, my friends. Dear Journal, today I made a very interesting video about journal entries. Oh, hi. Yeah, not that kind of journal entry. In this video, we're going to talk about journal entries in accounting. And we're going to take a different approach than we take in accounting class, for example. Because what I want to do is I want to give you a high-level view of journal entries, because there's several different types. So stay with me, and I'm going to get you through this. By the end of this video, you're going to be like, whoa, I totally get it. That's what we're going for here. Welcome to Accounting How To. I'm your host, Carolyn Grimm. That's my sidekick, Terrence, and we're here to put the fun in accounting fundamentals. The whole purpose of a journal entry is to record a business transaction. That's all it is. And the first rule of business is stuff happens, right? You sell something, you buy something, your employees come in and punch the time clock, you take out a loan, you use that loan to buy a truck, a customer returns something that they bought. Those are all examples of stuff happening in business. Those are all examples of transactions. So a journal entry is designed to capture those transactions in a way that's going to communicate with our accounting system. And each journal entry is going to show what accounts are being impacted by that transaction. Is our cash increasing or decreasing? Do we have revenue? So those are all things that we're going to tell our accounting system through the tool that is a journal entry. Now, the basic rule of a journal entry is that it is always going to impact at least two accounts. There's always going to be at least one account being debited and one account being credited. And we find those accounts that we're going to use in a company's chart of accounts. It's a listing of all of the accounts that are available to us, and those are the ones that we can choose. So you can think of journal entries like you're the sorting hat in Harry Potter. So you're going to tell the transactions which house they belong in. This one goes in Slytherin. This one goes in Gryffindor. Of course, as we all know, Ravenclaw is the best house for accounting students and accountants. Now, another way that you can look at journal entries is it's like a machine that separates M&Ms by color. You pull a lever and the red ones go that way, the brown ones go that way. That's what we're doing with the journal entry. Now, journal entries come in different varieties. We'll call them different flavors. Unlike M&Ms, which pretend that there are different flavors with their colorful candy shells, but really they're all the same flavor. Prove me wrong. But each flavor of journal entry serves a different purpose. So a regular journal entry, what we think of in Accounting 1 and all through accounting classes and in real world accounting, when we say journal entry, we mean basically a regular journal entry. And regular journal entries are for recording regular transactions, like buying something or selling something. Now, another type of regular journal entry is a compound journal entry. With a compound journal entry, it simply means that there's more than one debit and credit, more than one account being debited, more than one account being credited. So, for example, maybe you are paying two different types of expenses on the same check. So you're going to debit supplies expense and materials expense, and you're going to credit cash, for example. So a compound journal entry just has more than two parts to it. That's it. And then we have something called a correcting entry. Well, correcting entries are for exactly what you might think they're for. It's when we mess something up and we got to fix it. So a correcting entry makes our mistakes magically go away. It's very handy to have. So these are the accountant's version of a mulligan. And then we have something called adjusting entries. And adjusting entries are used to record changes in accounts that aren't part of the regular business transactions. So, for example, depreciation expense. You're not going to get an invoice for depreciation expense. So in order for that to hit our accounting system, we have to tell our accounting system that this needs to happen. So I have a whole series of videos about adjusting entries because there's a lot going on with them, and there are a number of different types of adjusting entries that you should be aware of. I mean, like if you were dating, an adjusting entry, your relationship status would be, it's complicated. So our last type of journal entry we're going to touch on today is something called a reversing entry. And reversing entries are exactly for reversing something that happened before. So, for example, we do something in the month of June and we want that to go away in the month of July, which sounds a little sketchy when I say it that way, but there's a legitimate reason for it, and we'll go over that in the adjusting entry videos. Now, the last type of journal entry that I want to introduce is something called a closing entry. And this is an entry that we do at the very end of our accounting period. So the end of the month, when we've done all of our other entries, this is the very last step that we're going to take. And basically, this is the magic entry that moves our net income, our profit, into our retained earnings, our equity account. So I've done a video on that as well because it's kind of a funky entry. And it's not something that we really do in real world accounting anymore because it's magically done for us by our accounting software. But for the purposes of our accounting classes, we do need to understand what a closing entry does and how that works. So if you're an accounting student, you'll want to check out the closing entry video. If you're a small business owner or a bookkeeper, you can probably skip over that one. But regardless of what kind of journal entry it is, what flavor journal entry it is, they all have the same format. We're going to have a date because that's important. We're going to have the accounts that are being impacted, and we're going to have the amounts that are being debited and credited. Now, you can't understand journal entries and how they work without understanding normal balances and the rules of debit and credit. So, of course, I've linked those videos down below if you need a refresher or if you're new to the whole debiting and crediting thing. So, as we close out this introduction to journal entries, just understand that the whole purpose of a journal entry is that you are telling your accounting system that something happened. There was a sale of some merchandise, or you purchased some supplies, or you paid your employees. Journal entries capture that information. And our job as journal entry creators is to act as the Harry Potter sorting hat and say, you need to go there and you need to go there. Ravenclaw forever. We'll see you in the next video. Is it a journal or is it a ledger? I always get those two confused. Today we're going to sort that out. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. Now, often when we hear the term journal now, we think of a book where we record our hopes and fears and dreams. But long before people had the luxury to sit around imagining their best life, journals were being used to keep track of transactions between businesses and between neighbors. So in accounting and business terms, a journal literally means that which takes place daily. It's a book for inventories and daily accounts. It's the ancient practice of keeping the books. So keeping track of transactions was critical because most transactions weren't done using cash. Barter was far more common. You'd exchange labor with a neighbor. You'd help prepare his field in the spring in exchange for him helping you cut timber in the fall. Now, if you had a neighbor who kept poor records, and you know that happened, you'd end up with arguments and bad feelings. And ain't nobody got time for that. So you would carry your journal around with you as you moved through your day, and you'd write down transactions as they happened. So here's an example of a daybook, a journal in olden times. Paid taxes with cash money. Cut timber for Mr. Bradford, who paid 3 cords of firewood. Repaired the roof for Goody Allen, who paid with 1 wheel of sharp cheese. Received 3 days' labor from Deacon Peabody to till the lower field in exchange for the same at a later date. Granted mortgage to Widow Freeman to be paid in 1 year. Sold eggs to Mrs. Olson at the mercantile on account. Then, back at your desk later on, after you've had a good meal with the missus, these transactions would be taken from your daybook, your journal, and then they would be entered into specific accounts, your ledger. So in your ledger, you would record that you paid your taxes to the town. You would be able to see the taxes that you previously paid, so you know that you have paid your taxes every year, and you would be showing how you paid for it. You paid for it in cash. You would record in Mr. Bradford's account that he paid you 3 cords of firewood in exchange for your labor. You'd record that you repaired the roof for Goody Allen in Goody Allen's account, and how she paid you was with that wheel of sharp cheese. You would record that you have received 3 days of labor from Deacon Peabody in his account, and that you still owe him for that. You still owe him 3 days of labor at a later date. And you would record that you have granted a mortgage to Widow Freeman, so you gave her the money, and she's going to repay that later on. So you have mortgage receivable now, and you have less cash. And of course, you're going to record that you sold eggs to Mrs. Olson at the mercantile, and that you are going to be receiving that payment later on in the form of goods. So once you've recorded all of these transactions in your journal and then transferred them to your ledger accounts, at some point in time, you're going to get together with those different people that you have accounts with, and you're going to settle up accounts. You're going to sit down and say, well, Deacon Peabody, this is where we're at. I've got this that you owe me. You've got that I owe you. And you're going to make a determination as to how that amount's going to get paid, or that you're satisfied the debt has been paid on whichever side it's on. Now, today's daybook might be a paper notebook, or it could be a computer app. But the intent is still the same. You're keeping track of your daily transactions so that nothing gets lost. And then you're going to enter that into your account ledgers in order to keep track of who you owe, who owes you, what you bought, what you sold. So a journal is where the original entry is made, the day-to-day entries, the journal entries. And then a ledger, an account ledger, is where we track the changes to the balances of every account that we have. Who do we owe? Who owes us? How much cash do we have? How much inventory do we have? And there you have it, the difference between a journal and a ledger. Until next time, stay balanced, my friends. Well, this is an exciting video. We are now moving out of spreadsheets and T accounts, keeping track of our transactions, and we are moving into big kid accounting. We're going to learn how to do journal entries. This is exciting stuff. Congratulations. In our other videos about analyzing transactions, we started with our kind of chapter 1 version of the expanded accounting equation. And then we went into using T accounts to track our debits and credits. And now we're going to jump right into what real accountants do, which is journal entries. So this is the way that you'll be doing your accounting transactions from here on out for however many accounting classes you take. So we're going to use our same transactions that we did for our spreadsheet version of analyzing transactions and for our T accounts version of analyzing transactions. So again, this spreadsheet is available for you to download it. It includes all of our transactions, includes our chart of accounts, and each one of these methods with the solution side of it so you can see whether you did things right. So let's jump into talking about our journal entries in general. So here we go. This is a typical setup for a journal entry. So we've got a date, we've got an account name, we've got a debit and a credit column. Debits on the left, credits on the right, always going to be that way. And then within this journal entry, we're going to give it a date. We're going to give it a debit account and a credit account. When we do our credit accounts, whether there's 1 or 21, we are going to indent so that it's easier to read it as you're scanning down a spreadsheet full of numbers. And then a lot of times in the textbooks that we use, it will say that explanations or descriptions are omitted for the purposes of the class. And that's really not good accounting practice. And the reason for that is when you put this little description in here, it helps to jog your memory about why you made that entry, but it also helps to set up footprints so that if another bookkeeper or accountant comes in after you, they're able to follow along with what you did and they don't have to come bug you and ask you a lot of questions. So for the purposes of our exercise here, we are going to include our descriptions, and in the accounting textbooks, do whatever they tell you to do, whether it's leave them out or include them. But basically what we're going to say in that description is to record something or other. So in this example, to record revenue from cash sales. So this is the format that we're going to use. And just like with anything else that we've been doing, debits are on the left, credits are on the right. Every debit has to have a credit. Every journal entry has to equal on the debit and the credit side. Now, journal entries can have multiple accounts. So you can have a journal entry that contains, 15, 20, 30 different accounts. It happens that way sometimes. If you're doing like a big adjusting entry at the end of the year, it can have a lot of different accounts to it. So let's dig into our transactions and we're going to do the journal entries that go along with them. So first thing that happens, we open a bank account, and I'm just going to make up dates because I didn't really assign any. So we open up a bank account to start this business bank account and to record that the owner is putting money into the business. So what are we getting? We're getting cash. So we're going to enter cash of $55,000. And then the other side of this transaction is going to be an owner's equity account. So in this case, we have an account called Joe Smith Capital. And we're going to come over here on our credit side and we're going to put $55,000 in. Boom, there we go. And then our description would be something like to record owner's investment. Journal entry done. Look at that. Woo, this is so exciting. And then I'm going to skip a line just for clarity. Back in the olden days when I started out in accounting, we were doing this in green ledger sheets. So It doesn't matter as much here, but it made it easier in green ledger sheets if you skipped a line and you're trying to scan down through a whole line of journal transactions. So the next thing that happens is we purchase office supplies on account. And I'll use 6/1 as my date again. So what are we getting? We are getting supplies. And this is supplies, the asset account, not supplies, the expense account. So we got $3,300 worth of supplies. And then how did we pay for them? Well, we haven't paid for them yet because it says that it's on account, which means that it is accounts payable, which is a liability account, so it's a normal credit balance, and we are increasing that by crediting the account. Boom, another journal entry done. We are cooking with gas. All right, so what happens next? I can't wait to find out. It's always so exciting to see what happens next. We received cash. Woo, love that. From fees earned, 18,300. So what are we getting? We are getting an increase to cash of 18,300. And then we are indenting, and the other side of this will be our revenue account fees earned. Whoops, fees earned-o. Earned-o. For $18,300. And you see that I already forgot to do something. We're going to jump back in here and say to record purchase of supplies. And then here we're going to say something like to record cash sales. All right. And then what happens? We're going to pay our rent. So we're paying our rent of $8,300. So let's see, rent expense, we're going to debit because it has a normal debit balance. So $8,300. And how are we paying for that rent? Well, we're going to pay cash. So we need to reduce our cash account by crediting it by $8,300 to pay rent expense. All right. Then what happens? We pay creditors on account for $22.90. Well, the only creditor that we know of, because this is a new business, he's only bought one thing, is we have this accounts payable here that we increased by $3,300. So now we are paying part of that bill, which means that we need to reduce our accounts payable. We increase it on the credit side, so we're going to decrease it on the debit side. Okay? So accounts payable, we're going to reduce it by $22.90, debiting it. And how are we paying for this? Well, it's coming out of our cash account, so we need to decrease our cash by $22.90 as well. This is to pay for supplies or something along those lines. Okay, and then the next thing that happens is we're going to bill our customers for fees earned, $30,800. And I'm going to make this as of the 30th of the month. Why not? Of course, in real accounting, you wouldn't make up dates. You would know what the dates were. So what are we getting here? We have just sold to our customers $30,800. And we haven't gotten the money yet. So this is now going to be accounts receivable, I before E, except after C, and we're going to increase our accounts receivable by $30,800. It is an asset. We increase it on the debit side. And the other side of that is our revenue. And our revenue account is fees earned. And we're going to put in $3,800. And this is to record sales. Now, let's stop right there and take a look at what we're not doing here in these journal entries. So we are not creating random account names. We're not saying rental expense instead of rent expense. And the reason that we are calling these things very specific names is because of our chart of accounts. So the only names you're allowed to use on your journal lines are these names from your chart of accounts, okay? So you don't want to start calling your revenue account revenue or fees revenue or professional fees or anything else because the name of your account is fees earned. So if you start getting all crazy and throwing in random things on these lines, it's going to really mess you up, but it's also going to mess the next person up. So if you are calling your fees earned by some other name, when we get to the point where we're going to post those to the accounts, we're not going to have a corresponding account. So make sure that the names that you're using in your journal entries are the exact names that you use in your chart of accounts. Okay? Important point to note. All right. So let's go back to our transactions. What happens next? We're going to pay some automobile and miscellaneous expenses. Okay, this is going to be fun for you. You just don't even know what's about to happen in your life, okay? So we're going to debit automobile expenses, or we called it, sorry, auto expenses. Don't want to be making up account names. We're going to debit that for $13.80. We are also paying miscellaneous expenses. So we are going to enter miscellaneous expenses as a debit of $1,800. So how are we paying this? We're going to pay this in cash. And that cash is going to be a combination of those numbers, which my patented lightning fast board math would tell me is 3180. So this is why this is so exciting. You have just done a compound journal entry. I'm so proud, really, really proud. So this is an example where we have more than 2 accounts being impacted. So in this case, we're doing 2 different expense accounts. So we've got 2 expense accounts and we've got our cash account. So 3 different accounts being impacted. And again, we got to make sure that those are in balance because everything has to be in balance. But that's an example of a compound journal entry. So big step in your accounting lives right there. So proud. Now what happens? Well, now we are going to pay our employees. So we are going to debit salaries expense for $7,300. And how are we paying them? Well, they're not going to take promises. So we're going to pay them in cash. We're going to cut them payroll checks. So we're decreasing our cash by $7,300. So I got so excited up here about your compound journal entry to record auto and miscellaneous expenses. I forgot the description. To record payroll. There we go. All right. So then what happens? Then the old tricky supply entry that we're going to do. And as I mentioned in the other videos about this particular transaction, they're actually sneaking in a Chapter 3 item. So this is an adjusting entry. So not only have you done a compound entry, but you're about to do an adjusting entry. Don't you feel accomplished now? This is great stuff. So this entry, we have determined that the cost of supplies on hand, what we have left over, is $1,250. So the cost of supplies that we used was $20.50. So we're going to move from our supplies asset account. We're going to move this now into our supplies expense account. So here we go. Here's our supplies expense. And we are going to increase that by $20.50. And we are moving it out of our supplies asset. So we're reducing our asset by $20.50. So this is another really good example of why you have to be very careful about what you use for account names in these journal entries. We've got two accounts that start with supplies. So if you mean supplies expense, but you say supplies, I'm going to put it in the wrong account. So you're going to be very careful that you're very specific about using those correct full titles. So here we go. We have moved it out of our supplies asset and into our supplies expense. We've just adjusted that account, and that's why it's an adjusting entry. And here we go. To record supplies used, or something along those lines for your description. And then as our final transaction for June, we are going to, our business owner is going to withdraw some money from the business. So in this case, we want to use our Joe Smith drawing account, and we're going to put our $13,800 in here, our $13,800 in here, and then 1, 2, 3, cash. We are reducing our cash by $13,800. So what we've done with that transaction is we have reduced his capital, his equity in the business, because he's taking some of it back out again. To record owner's withdrawal. All right, well, there we have it. That's our journal entries. And you know what happens now? We get to go home. No, we don't actually get to go home because there's a whole other step that goes along with this. So let me jump over to that other step. So once we've done all of our journal entries, then we need to actually go and post them to our accounts. So this is kind of like what we did with our T accounts, where we were posting things directly into our Ts. This is the expanded version of our T account. So this gives us the debit and the credit. It also gives us a balance line so that we can keep a running balance of what's going on in our accounts. So when we're talking about posting to these accounts, again, we're being very specific about those account names so that we aren't confusing supplies and supplies expense, for example. And then we're going to take each one of those individual journal lines, and we're going to enter that debit or credit in the appropriate account. So here's an example. We're going to put in our date. We're going to put in whether it was a debit or a credit, and then we're going to carry that over to the balance, and we'll keep a running balance for each one of those accounts. In particular, when you're thinking about your cash account, you want a running balance. Think of it like your bank register that you keep for your checking account. You want to know what your balance is so that you're not writing bad checks. So this is a much more efficient way of doing this as far as comparing T accounts to this method. Now, when we take our journal entries and post to these accounts, you're going to see that it is a very tedious process, right? And it's going to make you appreciate accounting software so much, okay? So let me just jump over to the solution part of the spreadsheet so you can see what's going on here. So here are our postings to our various accounts. All we've done is we've gone to each transaction. So here's our very first transaction where we said we were debiting our cash account. And then if we jump over to our equity account, here's the credit that we did. Okay, so that's what we're doing. We're going back and forth between those different journal entries and our general ledger accounts. And we're going to enter each one of those lines one by one. Now, one of the things that I've seen students try to do as a shortcut is to go through and post like all of the cash transactions, right? Because they think they're saving themselves some time. And then what happens is when they get to the point where they've entered all of these transactions, it doesn't come out correctly. And then they're faced with having to go back through step by step and try to figure out where they went wrong. So the best practice would be to take each journal entry and enter it one by one all the way through this whole process. Now, what I'm not going to do to you is go through and painstakingly enter all of these transactions because it will drive you nuts, okay? And I don't want to do that. So I'm just going to do a sample one. So let's say we have our first transaction that we just mentioned, and it was a debit to cash for $55,000. We're going to get rid of our little X's here that were just a placeholder. So we're debiting cash for $5,500. It is our first transaction, so we know that our balance is $55,000. And then we'll jump down to our capital account where we are going to enter our date. And we're going to enter that credit that we did in our journal entry for $55,000. And our balance will be $55,000. And then you're going to go through each and every transaction. Now, let's say you have a transaction to cash that's, say, a credit of $5,000. I'm just making that up. There is no entry for that. So then that's going to change our balance. We're going to take our debit balance of $55,000 and we're going to subtract $5,000. So our new balance is going to be $50,000. And again, you don't want to be doing anything over here on this other side unless your balance goes negative in your cash account. So you only want the balance on the side where it should be. So once you have posted all of those transactions painstakingly, entry by entry, you're going to take your balances from those accounts and you're going to bring them over into a trial balance. And we're going to just enter those balances that we pull from our accounts. So here's our 38,430, and we're going to go right down the line. And when we're all done, we should tie out debits should equal credits. And again, it doesn't mean that everything is posted in the correct account. Maybe you posted in the supplies asset account and you should have posted in the supplies expense account. Your debit's going to still equal your credits, even though your debit's in the wrong spot, if that makes sense. So all this is doing is checking to make sure that your debits equal your credits. And what this is a holdover from back in the olden days when I was just a young accountant. And we had to do all of these periodic checks throughout the accounting cycle. Now, again, when you're using accounting software, you're not going to go through this process because when you do a journal entry or you enter a bill or you enter an invoice for your customers, your accounting software is going to automatically post those transactions to the accounts. And then it's going to automatically create this trial balance account. But for the purposes of your first accounting class, you're going to have to suffer like the rest of us have suffered over the years and years and years that we've been teaching it this way. So get through it in Accounting 1 and know that you're never going to have to do this IRL in real life. Okay, so there you have it. We've now done our transactions 3 different ways. We've done it using a spreadsheet with the accounting equation, we've done it using T accounts, and we've done it doing journal entries. So that gives you a good idea of the 3 different ways that we do this, how they work, the fact that we all end up at the same place at the end, and the really great news that I'll leave you with, that you're never going to have to do this again when you're done with accounting class. So until next time, stay balanced, my friends. It's often said that old accountants never die. They just lose their balance. Well, by the end of this video, you're going to understand why that old accounting joke is funny. Welcome to Accounting How To. I'm your host, Carolyn Grimm. That's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. Now, way back in the day, when I was just a young cub accountant, and I first heard the term trial balance, I had no idea what that meant. Now, many, many years later, I still don't know what it means. And now, many years later, here I am having to explain this concept to a whole new generation of accountants. So let's see if we can break this down in a way that makes it super easy to understand. So the whole purpose of a trial balance is to make sure that your debits equal your credits. That's it. That's the whole purpose of it. So let me give you a little backstory on that. Back in the olden days, when I was just a young accountant, when we did everything manually, there were times in the accounting cycle where we needed to stop and make sure our debits and credits were in balance before we moved on to the next step. And here's how that looked. So we did all of our regular journal entries, our debits and credits to cash and accounts receivable and sales and all those different accounts. So we do all of our regular journal entries. And before we move on to the next step, we want to stop and we want to make sure that we have posted everything correctly to our accounts so that our debits equal our credits. Now, again, with a trial balance, we're not looking at whether we posted things to the correct account. We're just looking to make sure that our debits equal our credits. So when we get to that point in the accounting cycle where we've gone through and done all of our regular journal entries, then we're going to take our balances and we're going to pull them into a trial balance. So we're going to list all of our accounts out so that it looks kind of like this. So this trial balance I'm pulling from my analyzing transactions spreadsheet that takes you through how to analyze transactions using the accounting equation, using T accounts, and using journal entries. So I will put that spreadsheet in the description so that you can download it and work through those problems. So as you can see from this trial balance, what we've done is we've taken the balances from our general ledger, or our T accounts if we're using T accounts, and we're pulling them over into this trial balance. And if you look to the bottom of the trial balance, you'll see that our columns equal. That's what we're checking. All we're checking is, did we get our balances in the right spot? So if you look over to our cash balance, for example, you'll see we have a cash balance of $33,930. It is a debit balance, so we're going to pull that into our trial balance as a debit balance. So we're just going to mirror that from our general ledger to our trial balance until we get to the bottom and we add everything up and magically we equal. Now, sometimes we don't. Okay, it happens. So if we get to a point where our debits do not equal our credits, then we've got to go back and check each account to see where the problem is. And a lot of times what happens is when you're pulling those balances manually, you enter them on the wrong side, for example. Or it could be that you transposed a number when you were bringing those numbers over. Manual accounting has a lot of opportunities for those kinds of errors. Or it could be that in your journal entries, you posted something incorrectly. You put $100 in one account and you put $10 in another account. Again, things happen. So this is an opportunity for us before we move forward to make sure that our balances are in balance. It's all about being in balance, you see? So now in the accounting cycle, the point that we're at is we've checked to make sure that our balances are equal. We have debits equaling credits. This is also known as the unadjusted trial balance because we haven't adjusted our accounts yet. And of course, we have a video series about adjusting entries. But for right now, let's just talk about unadjusted trial balances. And then we're going to move to that adjusted trial balance. So the way that we get from our unadjusted trial balance to our adjusted trial balance is through doing those adjusting entries. And these are the entries that we need to do to make sure that we are accounting for things like unearned revenue now being earned revenue, or we're accounting for depreciation expense for our big assets like buildings and vehicles. So once we have done our adjusting entries, we now post those to our accounts just like we did with all of our other regular journal entries. Once we've updated the balances in the accounts, now we're going to do what's called the adjusted trial balance. And that's just updating those numbers. So everything's coming back over just like it did before, and we're going to have a new trial balance that is an adjusted trial balance. It's going to look the same. The numbers will be different if we've done adjusting entries. Now, once we've done those adjusting entries and we have our adjusted trial balance, this is the point where we are going to go do our financial statements because we've made sure all of our balances are where they need to be. And now it's okay to go ahead and create our financial statements. Now, once we do our financial statements, we still have a couple of steps to go in the accounting cycle. And the next piece of it is that we need to do something called closing entries. When we do our closing entries, and again, there's a video for that, right? Because that's what I do. I do the video, you do the watching, you get smart. It's awesome. Love it. So when we do our closing entries, we're going to do the same thing that we did with our regular entries and with our adjusting entries. We're going to post them to our accounts. And then we're going to do a final trial balance. And this is called the post-closing trial balance. So this is going to update those accounts again. So what the balance is at the end of the month is the balance for the beginning of the next month, right? So we're going to have our cash balance, we're going to have our accounts receivable balance, we're going to have our equity balances. They're all coming in to the new month. Once we do our post-closing trial balance, that is the end of the accounting cycle for this month. And now we start all over again for the new month. So for trial balances, we have those 3 moments in time where we are checking to make sure that our debits equal our credits. And that happens after we do our regular journal entries, our adjusting journal entries, and our closing journal entries. Now, how does this translate to the real world where we really don't do manual accounting anymore? Well, the good news is that if you're using a software program, it will not allow you to save a journal entry if it is not in balance. So your debits are always going to equal your credits. So trial balances they're not quite as useful as they would have been back in the old days, but they are used by accountants to look at the balances, to see if there is anything that needs to be adjusted, to see if there's anything that looks out of place. It's a really nice tabular form to look at all of your account balances in one place. So that's really helpful. That's something that we use regularly. So when we take our trial balance and we look at it and we say we need to make some adjustments, we still do journal entries to make those adjustments. And then our trial balance is going to automatically update. There's no going back and forth, posting accounts, moving things around, transposing numbers, swapping, putting things on the wrong line. That all goes away. Thank you. And as far as closing entries in a post-closing trial balance goes, we no longer need to worry about if we're using software because we don't need to close out our revenue and expense accounts because everything that we do in software is by date. So in the background, your software is automatically going, okay, yeah, we need to move this, we need to move this, we need to move this. We don't have to worry about closing entries. So that's all going to go away. So in your software, any report that you want to run is all going to be based on dates. And you've got a lot of great things going on in the background that are taking care of some of the old school posting to accounts and trial balances and all of those things go away. But it's important to understand what's going on in the background, especially if you are a business owner or a bookkeeper who's setting up the books for a company. It's really helpful to understand what's going on in the background so that you know when your software asks you a question, you can answer it confidently. So as far as trial balances go, with the exception of adjusting entries, it's a throwback to the old way that we used to do things, the manual accounting that we used to do for thousands of years. Now, for my accounting students, you'll want to go through the adjusting entries videos and the closing entries videos because you're going to need those for your accounting class. For my business owners and bookkeepers, you can skip the closing entry part because you're never going to have to do that. But you do need that adjusting entry part in order to really understand what it is that we're adjusting, why we're doing it, and how to do it correctly. So there you have it. Trial balances explained, what you need to know, what you don't need to know, depending on which path you're on. And so, until next time, my friends, try to stay balanced. See what I did there? Trial, balance. Yeah, I know. It's hilarious. You'll get it later. It's fine. Ladies and gentlemen, in this corner, weighing in at 100 pounds soaking wet, we have the wildly popular cash basis accounting. Woo! And in this corner, wreathed in GAAP approval, we have accrual-based accounting. Which accounting basis will win this slugfest? Stay tuned, fight fans. Oh, hello. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and this is my sidekick, Terrence the T Account Rex. Whew. And we're here to put the fun in fundamentals of accounting. And we're here today to explain the differences between cash basis and accrual basis accounting. Is one better than the other? Let's find out. When we set up the accounting books for a company or an organization, we need to make some decisions. And one of those decisions is whether we'll use cash basis or accrual basis for tracking our revenue and expenses. Now, to understand the concept of cash basis and accrual basis accounting, we first need some grounding in GAAP. So what is GAAP? GAAP is Generally Accepted Accounting Principles. Now we covered GAAP in more depth in another video. But for this video, we're most focused on two principles. The first one is revenue recognition, and the second one is the matching principle. So the revenue recognition principle gives us guidance on determining when we have revenue and when we have an expense. And the matching principle tells us that when we have revenue, the expenses that we incur in making that revenue need to be recorded in the same time period. Let's make it easy by looking at an example. So let's say we have a retail store, and in December, we have $10,000 in sales. And we need to match the expenses that go with that revenue and make sure that they show up in our financial statements for December. Now, let's say we bought $5,000 of inventory in November, and that's what we sold in December. And let's say we aren't paying for the inventory until January, and our customer isn't paying us the $10,000 until February. So we now have a scenario that crosses 4 different accounting periods: November, December, January, February. And it also crosses 2 accounting years, assuming that this company is on a calendar year basis. Pretty confusing, right? So in this scenario, when do we have revenue and when do we have an expense? Well, it's all about timing. So when we're talking about cash basis accounting versus accrual basis accounting, this is where we're going to see our big difference. So under cash basis accounting, we recognize revenue when we receive the cash. And we recognize expenses when we pay out the cash, when we pay that bill. Under accrual-based accounting, we recognize our revenue when we earn it, not when we get paid for it, when we earn it. And we recognize our expenses when we incur them, not when we pay them. So which is better? Well, it depends. So cash basis gives you a better view of cash inflows and outflows. And this is a really important thing for a business to understand, because cash is what keeps the business going. Cash is the lifeblood. If we don't have adequate cash to pay the bills, to buy more inventory, we don't have a business that's going to be able to operate for very long. But accrual basis gives you a much more accurate picture of profitability. So when we have revenue, what are the expenses that go with that revenue, and what is our profit based on that? Now that gives you another really important view of your business. So on one hand, you're looking at cash in and out, and on the other hand, you're looking at, are we making a profit? So if you're a small business, you can use cash basis accounting. And the reason that small businesses often use cash basis accounting is, first of all, it's easier to keep track of things, but it's also focused on that cash piece of it because cash is such an important piece for small business owners. But bigger businesses are required to use the accrual basis of accounting. But let's take this example and walk through and see what the differences are between using cash basis and using accrual basis. So our first slide lays out the timing of these different transactions. So we bought inventory in November for $5,000. In December, we sold it to our customer for $10,000. And then in January, we paid our supplier for that inventory. And in February, our customer actually pays us. So those are the time periods that we're looking at: November, December, January, February. So as far as our customer transaction goes, we sold to our customer in December $10,000. And then 2 months later in February, we got paid for that sale. So when do we have revenue? Do we have revenue in December or do we have revenue in February? And then when we're looking at the expense side of it, where we bought the merchandise that we were going to sell to our customer, we bought the inventory in November and we paid for it in January. So when do we have an expense? Well, under cash basis accounting, we have revenue when we receive the money for it, and we have an expense when we pay the cash out for that. So revenue when we get cash and expense when we pay cash out. So under cash basis accounting, we have revenue in February when we actually received the money. And we have an expense in January when we actually paid for that merchandise. Now, the thing with cash basis accounting is that it does not conform to GAAP, to our generally accepted accounting principles. We're still able to use it as a small business, but it does not conform to GAAP. We're not following the rules for recognizing revenue expenses, and we're not following the matching principle. So let's look at what our profit and loss, our income statement, would look like under cash basis accounting. So for the month of November, we did not take in any money and we did not pay out any money. So we have 0 in revenue and 0 in expenses, and therefore 0 in net profit. In December, it's the same thing. We did not pay out anything and we did not receive anything. So again, we have a profit of 0. Well, then in January, when we actually pay the bill for the merchandise that we bought, we have an expense of $5,000. We have no revenue to match that up with. So what we have is a loss of $5,000. And then in February, when we receive the cash from the customer, we are now going to recognize $10,000 in revenue, but we have no expenses, so it looks like our profit for that month is $10,000. Is that really accurate? Did we have a loss in January and a profit in February? Well, under GAAP, no, we didn't. But under cash basis accounting, that's exactly what's going on. And again, it's perfectly fine for a small business to use the cash method of accounting. But from an accounting perspective, it's not necessarily the best way to go because it isn't matching up your revenue and your expenses. So you don't really know what the profitability of your business is. All you know is what your cash flow is. So now let's look at that same scenario under the accrual basis. And the accrual basis is GAAP approved. So under the accrual basis, we recognize our revenue when we earn it, and we earned it in December when we shipped that merchandise off to our customer. And because of the matching principle, the expense that goes along with that was originally in November, we need to shift that over into December so that we have our revenue recognized and our expense matched up to that revenue in the same accounting period. And so what that does for our financial statements is it gives us zero revenue, zero expenses in November. It gives us $10,000 in revenue and $5,000 in expenses for December, giving us a profit in December of $5,000. And then because nothing happened in January or February, we didn't sell anything to our customer, so we don't have any revenue, and we didn't buy anything, so we don't have any expenses. We end up with a profit of $5,000 in December. Now, with our cash example, if we looked at the whole period of time from November to February, we did have a $5,000 profit overall. So it ends up being the same after some period of time, but we aren't able to see the profitability as well under cash as we are under accrual. So with accrual, we know that in the month of December, we had a profit. It's not carrying on into January and February of the next year. We can look at it and say, we had $10,000 in revenue, it cost us $5,000 to make that revenue, and we had a profit. And again, perfectly acceptable for a small business to use cash basis accounting, but they could just as easily choose accrual based accounting. Now, when we're talking about accrual based accounting, we're talking about using accounts like accounts receivable and accounts payable. And that's part of what helps us to capture things in the month where they need to be captured. So if you're using accrual basis accounting, we have to have a mechanism that moves revenues and expenses around to get them into the correct accounting period. Well, that mechanism is called adjusting journal entries. And guess what? There's a playlist for that. You'll find the link in the description. Now, the good news is this. You can have the best of both worlds. You have to make a choice whether you're going to use cash basis or accrual basis, but you can get a picture of your business based on either cash or accrual. So you can get a picture of the cash part of it, the cash in and out, and you can get a picture of the profitability, the revenues and expenses being matched up. And you can do this within your accounting software by just the click of a button. So here's an example from, this one happens to be from QuickBooks Online. It's one of my sample companies that I use. And you can see that with a click of a button, I can look at a report either in cash basis or accrual basis. So you get the best of both worlds. And so now that you have a basis, if you will, see what I did there? In cash and accrual basis accounting, now you can jump into adjusting entries and get to understand those as well. So until next time, stay balanced, my friends. Oh, boy. There are things in life that just need adjusting, like our spines, the volume, our attitudes, and our accounting records. We're going to work on one of those things today. And I have to tell you, I wish that we were working on Terrence's attitude. There's not much I can do there. So let's work on adjusting our accounting records instead. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my grumpy sidekick, Terrence. We're here to put the fun, Terrence, in accounting fundamentals. So our job today is to tackle the concept of adjusting entries. So the first thing we have to talk about is why we need to do adjusting entries. So when we talked about journal entries in general, we said that an adjusting entry is not a correcting entry. It's not that we're correcting a mistake that we've made. An adjusting entry is done because there are accounts that have balances that are no longer accurate. We'll get into some specifics here in a moment. So when we use the accrual basis rather than cash basis as our method of accounting, we have some extra things to track. Now, if you haven't seen the cash versus accrual basis video, I'll link that up in the corner. But under accrual accounting, we need to make sure that we are recognizing our revenue when we earn it. And we need to make sure that we are recognizing our expenses in the month of that revenue, the matching principle. So we want to make sure that our expenses end up with the revenue that generated those expenses, because it takes money to make money, right? So we do adjusting entries once a month on the last day of the month. Now, we don't have to do them on the last day of the month, but they need to be dated on the last day of the month. And the reason for that is it makes it really easy for us if we've got to go back and answer a question, or we need to make a change to a journal entry. We know that those adjusting entries are always going to be the last day of the month, and we do them after we have taken care of all the other regular entries for that month. So what kinds of adjusting entries do we need to do? What kind of accounts are going to be impacted by this? Well, we're going to be impacting both balance sheet accounts and income statement accounts. So balance sheet accounts, as you remember, are assets, liabilities, and equity. And our income statement accounts are revenue and expenses. So we're going to be impacting a balance sheet account and an income statement account in every adjusting journal that we do. Now, within the accounts that we already have, that we've already been talking about, we now need to add on some new account names. So here's your rule of thumb. As we're adding these accounts, if you see an account that has prepaid something, that account is going to be an asset. So the account type is an asset, has a normal debit balance, so we increase it on the debit side, decrease it on the credit side. Nothing has changed here. So anytime you see something prepaid, whether it's prepaid expense, prepaid insurance, prepaid rent, if it says prepaid, it is an asset. The other new account that we're going to run into would have unearned in its name. So unearned revenue, unearned rent. If it says unearned, then the type of account is a liability. A liability has a normal credit balance, so it's going to increase on the credit side and decrease on the debit side. So anytime you see something called unearned, it is a liability. Now, every prepaid account, every prepaid asset has an associated expense account. For example, prepaid insurance has an associated account called insurance expense. When we had supplies that we then moved over to our expense account, we had supplies, the asset, and we had supplies expense. If we have prepaid rent, we're also going to have rent expense. So every prepaid asset account is going to have an associated expense account. Now, on the unearned side of things, unearned revenue, unearned rent, we're going to have a revenue account that goes with those. So the unearned part is a liability, and then we have an associated revenue account to go with that. So unearned revenue, revenue, unearned rent, rent revenue. And the job of our adjusting entries is to move things between those accounts. So we're moving things from prepaid insurance to insurance expense. We're moving things from unearned revenue into revenue. That's what adjusting entries are going to do for us. And as I mentioned, every adjusting entry has one income statement account and one balance sheet account. So if we're moving from unearned revenue, a liability, we're then going to be moving into revenue, which is an income statement account. Now, one thing that you should never, 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 never put into an adjusting entry is cash. So there should never be an adjusting entry ever that involves cash. Because think about that. Can you just adjust your cash? I mean, if you could do an adjusting entry to adjust cash, I would be doing that all day long. adjust my cash, debit that thing like crazy. Come on. So no cash in adjusting entries is what I'm saying. And I want you to understand I'm saying there is no cash ever in an adjusting entry. Okay. I say that like 50 times in my accounting classes. Every single time somebody will debit or credit cash. Oh, ugh. So the key to understanding what needs to be adjusted is to know the history of the transaction. So let's go through some of those. Let's say that we've contracted with a customer. We're going to do a project for them. And part of what we require is that they give us a deposit. So our customer gives us a $500 deposit, and we're going to do the work next month. So based on the revenue recognition principle, we can't claim that income yet because we haven't earned it. We can only claim revenue when we have earned it. So what happens in that original transaction? Well, we're going to increase our cash, $500, we're going to debit it, and then we're going to increase this account called unearned revenue by $500. It's a liability, normal credit balance, increase on the credit side. So what happens if we don't do this job for this customer? We got to give the money back, right? So it is a liability. We owe that money to the customer until we do the work. So the original transaction is going to be a debit to cash and a credit to unearned revenue. Well, when we actually do the work, now what we've got to do is we've got to move it out of unearned revenue and into revenue. So we're going to do that by debiting unearned revenue to decrease it and increasing our revenue by crediting it. So when you think about adjusting journal entries, think about what the original transaction was. You're not starting at the beginning when you're doing an adjusting entry. You're coming in later on. So keep that in mind as you're looking at adjusting entries. What was the first thing that happened? What happened with those accounts? And now how do you need to adjust them to make them be the correct balance once you have done the work? Let's look at another situation. Let's say that on January 1st, you pay 1 year's insurance premium for $1,200. Now, you're not going to claim this as an expense in January because it's for the whole year. So you want to split that up over 12 months. So every month you're going to do one entry for 1 month's insurance. So what happens in the original transaction? Well, we've got this asset, just like accounts receivable has value, a prepaid asset has value, right? If we cancel our insurance policy, we get that money back. So until we use it up over that 12-month period, it has value, so it sits on the balance sheet as an asset. So in the original transaction, we are going to debit this asset called prepaid insurance, and we're going to credit cash because that's how we paid for it. We wrote a check. So then at the end of January, the first month has passed. We have used up 1 month's worth of insurance. So we're going to reduce that asset by crediting it $100. And the other side of that is going to be a debit to insurance expense. So as we use up that asset, it becomes an expense. We're moving from the balance sheet over to the income statement. Now, usually when we explain adjusting entries, we split them up into accruals and deferrals. But for me, it makes more sense if we look at revenues and expenses, and then we look at accruals and deferrals below that. So let me see if I can explain that. So our revenue-related transactions may be accruals or deferrals. Our expense transactions may be accruals or deferrals. Well, what does that mean? What's accrual and deferral? What is this language I'm speaking here? So in accounting, an accrual means that cash comes after the transaction. So you sell to a customer on account, or you buy from a supplier on account. So you sell the thing to your customer, but you haven't gotten the cash yet, right? So it's an accounts receivable. Or you buy something from your vendor and you're going to pay later. So an accounts payable. So an accrual means that cash comes after. And you can remember that because accrual and after both start with an A. So a deferral means that cash comes before the transaction. So unearned revenue, we got that deposit from our customer. We got the cash first. And with our prepaid expenses, our prepaid insurance, our prepaid rent, we are paying before the transaction, before we actually are using that insurance up. So accrual, the cash comes after, and deferrals, the cash comes before. So under the revenue side of things, we could get cash before the transaction, a deferral, or we could get cash after, accounts receivable. On the expense side, we could be paying later because we bought it on account. That would be an accrual, cash comes after, or we could be prepaying, a deferral. The cash comes before the transaction. So we're going to get into those in depth in 2 other videos. I'm going to split out the revenue and the expense adjusting entries so that we can really go in deep on each one of those and understand them better. So in our next videos, we'll get deeper into the revenue side and the expense side. And we'll go through the typical transactions that you would see, both the beginning transaction and then the adjusting entry that goes along with them. So join me in the next video. Until then, stay balanced, my friends. In part 2 of our mini-series covering adjusting entries, we're going to cover revenue-related transactions. If you haven't watched part 1, I'll link it up in the corner. I recommend that you start there. Otherwise, confusion, chaos, crying, nobody needs that. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. Now, as we talked about in the introduction to adjusting entries, at the end of every accounting month, we need to look at our accounts and make sure that we have an accurate balance in those accounts. So sometimes things have changed and they need to be updated. So in this video, we're going to explore our revenue-related adjusting journal entries. So when we're talking about adjusting entries, the first thing that we need to determine is this a revenue-related entry or is it an expense-related entry? So if it is a revenue-related entry, things like unearned revenue and revenue, accounts receivable, and some kind of revenue account, those are revenue-related entries that we're going to work on. So once we've determined that something is a revenue-related journal entry, the next step is to decide whether it's an accrual or a deferral. So an accrual means that the cash comes after. And you can remember that because cash after starts with an A, accrual starts with an A. So cash comes after, it's an accrual transaction. If the cash came before, then it's going to be a deferral. Don't get hung up on that because we're going to dig into it so that you can understand it better. So when we're looking at a revenue-related adjusting journal entry, we're going to next ask, what are the accounts that are being affected? So if it's revenue-related, there's a clue there. It's probably 100% going to include a revenue account. Well, with our revenue accounts, we can often have an associated liability account called unearned revenue or unearned fees or unearned whatever. Now, the other thing that can happen with a revenue-related transaction is that the other side of it is not a liability, but it is an asset. So an asset like accounts receivable. So when we're looking at a transaction, and we're going to look at a bunch of transactions, we're going to be looking at what are the accounts being affected. Is it a revenue account? And is that revenue account going to get paired with a liability account, or is it going to get paired with an asset account? So if it is a deferral transaction, meaning the cash came before, like for example, we received a customer deposit, the cash came before, we can't claim that revenue yet because we haven't earned it. So a revenue in that case is going to be a deferral. And that means that we're going to debit a liability account and we're going to credit a revenue account. Again, don't get worked up about this yet because we're going to go through some transactions so that you understand what that means. Otherwise, it's just me going, all right. So if it is an accrual for a revenue account, the cash came after, then we're looking at debiting something like accounts receivable and crediting revenue. And this is a typical transaction that we've already seen because it's a normal transaction. We're going to debit accounts receivable, we're going to credit revenue. That's an accrual. Accounts payable, same thing. It's an accrual. We just didn't know yet what it was, but now we do, right? Now, every adjusting journal entry is going to impact one balance sheet account and one income statement account. Balance sheet account, assets and liabilities. Income statement accounts, revenue and expenses. So we're going to be impacting one balance sheet, one revenue. So we're going to be impacting one balance sheet account and one income statement account in every transaction that we're going to do. So let's look at some examples because that's when it's going to really start to make sense, right? It's not going to be me just, ugh. So in our first transaction, we receive $500 as a deposit from our customer for work that's going to be done next month. So question number one, is it revenue related or is it expense related? Well, it's not spending money, right? We're going to get money, so it's revenue related. The second question is, did the cash come before or did the cash come after? Well, in this case, the cash came before we did the work. So this is not an accrual with the cash coming after, it is a deferral with the cash coming before. So we're getting the cash before we do the thing that we do. So the original transaction, when we received this money, we would have debited our cash account to increase it, and we would have credited this account called unearned revenue. So unearned revenue is a liability account. So anytime you see something called unearned whatever, it is a liability account. So in this case, we're using the term unearned revenue. It could be unearned rent, could be unearned subscriptions, unearned insurance premiums. It could be anything. But there is going to be a liability account called unearned something that's going to match up with a revenue account. So in this case, we've got unearned revenue, and then later on we'll have revenue once we've earned it. So in this case, we have a liability. We owe the customer that money until we do the work. So cash, debit $500, unearned revenue, credit $500. It is a liability. So now time has passed, as time does so quickly. So we have completed the customer's work. So now what needs to happen is we need to take that unearned revenue liability and we need to get rid of it because we have completed our transaction for this customer. So we're going to debit unearned revenue to decrease our liability, and we're going to move it now into revenue because we've earned it, and when we've earned revenue, we can claim it. So we're going to credit our revenue account by $500. So when you're doing adjusting journal entries, it's really important to understand what the original transaction was. And if you're doing this as an accounting student, you're going to be thrown things without that context. And so what you need to do is to understand the context from your own knowledge, because the textbook is not going to tell you. So you're going to have to be able to think this through. So always think in terms of what was the original transaction? Where would this have gone? Now, in our second transaction, let's look at this situation. A customer prepays us rent. So we have a building that we're renting out, customers paying us rent. So they have prepaid us 3 months rent at $400 per month. So they're paying us $1,200 for 3 months of rent in advance. So the original transaction would have been, we received cash, $1,200, and this is going to go to a liability account called unearned rent. So we are using that liability account to keep track of the rent that our tenant has paid us in advance. So the original transaction, we're debiting cash to increase our cash, and we are debiting this liability called unearned rent. So a month goes by. At the end of that month, the first month that has expired, we have used up $400 of that prepaid rent. So now we need to take 1 month's rent, $400, out of our unearned rent account, and we need to move it into rent revenue because we've now earned that rent. So we're moving it from our liability into our revenue account. We've now earned it. Now, if we did not do that, we just left it sitting there in our unearned rent account, we would not have an accurate picture of what's going on in our business. We would not have revenue to report on our income statement, and we would have this liability on our balance sheet that was not correct. So when we do an adjusting entry, what we're doing is we're making sure that things are in the categories that they need to be in. Now, those were 2 examples of deferrals. The cash came before. Now let's look at an example where the cash is going to come after, an accrual. So in this case, we have a customer that we have done work for, but we have not yet billed them. And this happens in my business. If I'm working on a project and it carries from 1 month into the next month, I'm probably not going to do an invoice in the first month and then do another one in the second month. I'm going to wait and do one invoice at the end of it. But in that first month, I have earned the revenue, right? I better have. So I've done work for my client, but I haven't billed them yet. So here's what that's going to look like for the original transaction. There isn't one. So we haven't done anything yet. But what we do need as an adjusting entry is we need to recognize that revenue for the month that we're in. So we're going to do an adjusting entry for an accrual. The cash is going to come after. So in this case, we're going to debit accounts receivable for $500, and we're going to credit our fees earned revenue account for $500. And this acts as a placeholder. So later on, I will bill that client. But for right now, what we need to do is we need to recognize the revenue, and we need to have that placeholder of an accounts receivable amount that we will get later on. So an accrual is going to impact something like an accounts receivable for revenue-related transactions and accounts payable for expense-related transactions. So those are the typical kinds of adjusting entries that you will see for revenue-related transactions. And if you're one of my accounting students, those are going to be the typical adjusting entries that get thrown at you in your first accounting class. And so you'll have a better understanding of those, and you'll be able to rock those on your homework and your test. So in the next video, we're going to jump into expense-related transactions, and we're going to break those down by accruals and deferrals. And then in the final video for this series, we're going to go through an entire example of these transactions and then take it into an adjusted trial balance and then into financial statements. So you're going to get the whole picture, soup to nuts. So I'll see you in the next video, and until then, stay balanced, my friends. In part 3 of our mini-series covering adjusting entries, we're going to cover expense-related transactions. If you haven't watched part 1, I'll link it up in the corner. And I recommend you start there. Otherwise, misery, despair, sobbing. Nobody needs that. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence, and we're here to put the fun in accounting fundamentals. So when we're talking about doing adjusting journal entries, the reason for that is because we may have transactions that have not been captured in our accounting records, and we need to make sure that our balances are accurate as we close out the month. So when we're talking about adjusting entries, the first thing we need to talk about is it a revenue-related transaction or an expense-related transaction? Well, in this video, we're going to be talking about expense-related transactions. So once we've determined that it is something that's going to impact an expense, for example, prepaid insurance and insurance expense, then we need to determine whether it is an accrual or a deferral. Accrual means that the cash came after. Deferral means the cash came before. So we paid our insurance premium for a year. The cash came before we got the benefit of our insurance policy because it's spread out over a year. And then we need to look at which accounts are being affected. So when we're talking about expense-related adjusting journal entries, what we're looking at is assets and liabilities, and those are getting matched up with an expense of some kind. And don't let that twist your brain yet, because we're going to go through examples so that you can see this in action. Every adjusting journal entry that we do is going to impact one balance sheet account, either assets or liabilities, and one income statement account, either revenue or expenses. In this case, we're talking about the expense side, so you can probably already tell we're going to be dealing with expenses, not revenue. So let's take this to specific transactions so that we can understand it better. Let's dig in. So here's our first transaction. Now, if you watched my Analyzing Transactions video series, we already saw an adjusting entry. They slipped it in on us. So here is the classic one that our accounting textbooks like to use. We use $100 of supplies that we purchased previously. So our original transaction would have been something like this. We bought supplies for $500, so we're increasing our asset called supplies. And in this case, we'll say we paid cash. It could have been accounts payable, but let's say it was cash. So now we have what essentially is an inventory of supplies that we will be using up as the month goes on. So we get to the end of the month, we do a quick tally on our supplies closet, and we find out that we have $400 left in our supplies closet, which means that we have used up $100 worth. So now we need to move that out of our supplies asset account and into our supplies expense account. So when you use up an asset, it becomes an expense. So we're going to do an adjusting journal entry, and it is going to be a debit to supplies expense for the amount that we've used up. We can now recognize that expense, and we're going to reduce our supplies asset, our inventory of supplies account, by $100 by crediting it. So now the balance in our supplies account will be the $500 minus the $100 that we just took out. So we still have a supplies balance of $400 on our balance sheet. And you'll see that we did one expense account and one asset account. So we've got a balance sheet account and an income statement account. Now let's say we have either a store or a factory, and we are buying either raw materials or merchandise that we're going to then sell to our customers. So this works the same way as our supplies and supplies expense transaction did. In this case, we're going to use up $500 of our inventory. We've either turned it into a product if we're running a factory, or we have sold it to our customers if we have a store. So we used $500 of inventory that we previously purchased. So the original transaction would have been something like inventory, $2,000, and cash, $2,000 or accounts payable, it doesn't matter. But the inventory piece of it is an asset. This is something that we own as the business that we are going to then use to make money. So it is an asset. And as we use that up, it's going to become an expense, just like our supplies and supplies expense. Now, in this case, we're going to have a new expense account called cost of goods sold. If it's a retail store, you might see it called cost of merchandise sold. Both of those, cost of goods sold, cost of merchandise sold, those are expenses. So they have a normal debit balance. They increase on the debit side, decrease on the credit side. So we bought $2,000 of inventory. Right now on our balance sheet, it says we have $2,000 in inventory, but we actually don't because we've sold 500 of that. So once we sell that merchandise, we now can claim the expense. So we put it in our inventory holding account. It's there for us to sell. And now it's no longer there for us to sell. And we have to recognize our expense. So our adjusting entry is going to be a debit to this new expense account called cost of goods sold or cost of merchandise sold. And we're going to credit our inventory $500 to reduce it. So one balance sheet account, our inventory, one income statement account, our cost of goods sold. And now on our balance sheet, once we've done our adjusting entry and posted it to our accounts, now we're going to see the balance in our inventory account will be $2,000 minus $500, giving us a balance of $1,500. How are we doing so far? Good? Okay, let's keep going. So now let's talk about another typical transaction that we would see. And again, with the supplies and the inventory, those were situations where the cash came before. We bought the stuff before we used it. So it's a deferral. Cash before is a deferral. Now here's another deferral. So we prepay our insurance. Our cash comes before we get the thing, our insurance. So we prepaid $1,200 for 1 year's insurance. And now we've used 1 month of that. 1 month has expired, as we like to say in the accounting biz. So our original transaction would have been a debit to this asset account called prepaid insurance. And remember, anytime you see prepaid, it's an asset. So we have prepaid insurance asset that we are debiting by $1,200, and we have cash being credited for $1,200. So we're prepaying for a year's worth of insurance. We can't take this as an expense because we have to match our expenses to the period of time where we earn the revenue. So in this case, we prepaid 12 months of insurance. We're going to split that into 12 different months. So when it comes time to do our adjusting journal entry at the end of the first month, we've used up 1 month of insurance. So our adjusting entry is going to be insurance expense for $100 debit and prepaid insurance for $100 credit. So we're increasing our expense because we can now claim that expense because time has passed. And we are decreasing our prepaid insurance asset because it's no longer worth $1,200. Now it's worth $1,100. So those are the typical deferral of adjusting entries that you will see as accounting students, and they're pretty typical for businesses as well. So now let's look at some accrual transactions. Cash comes after. We have not prepaid anything. We're going to pay it later on. And our everyday transactions that we do with an expense and accounts payable, those are examples of accruals. So we buy the thing, we incur the expense, and we're going to pay it later. That's an accrual. But when we're talking about adjusting journal entries, there are some additional things that we may need to look at. And one of the typical ones that we run into is wages payable. So we have incurred expense, wages expense, but we have not paid our employees yet. And the classic example of this is that the last week of the month, our employees have earned wages. We have incurred an expense, wages expense, but payroll isn't until next week, which falls in the new month. So we still need to claim that expense in the month where it belongs, the matching principle. And so we need to do kind of this holding account where we're going to recognize the expense and recognize that we owe this to our employees. So what's our original transaction? Well, there isn't one yet. Our employees have been punching the time clock, but we've not done anything in our accounting records. So now what we need to do is this adjusting entry that will later on be replaced with a payroll entry. So we're going to debit wages expense for the amount that we owe our employees, and we're going to credit this liability called wages payable. So we're going to debit $400 to wages expense, credit $400 to wages payable. Now let's say that you have incurred an expense, but you haven't received the bill for it yet. So I'm going to use utilities expense as an example here. Now for some businesses, utilities expense is a huge number. Let's say you're running a factory and you're waiting for your electricity bill to come in. It could be a huge number. So that needs to end up in the month where it belongs, even though we don't have the bill yet. So our original transaction, well, there isn't one because we haven't received the bill yet. So we didn't do utilities expense and accounts payable. We haven't received the bill. So how would we know how much it is? The way that we're going to know how much it is we're going to make an estimate. So we can look at, 12 months of utility bills and say, well, we expect that our utility bill that's coming in will be somewhere in the neighborhood of $10,000. So in this case, we're going to say it's $100. This is a small business. $100 is a material amount, meaning it's big enough to matter. We're going to debit utilities expense and we're going to credit accounts payable. And then once we get the actual bill, we're going to do an entry based on that updated number. Now, the final entry that we're going to talk about is kind of a big deal, and that is depreciation. So because there's so much to depreciation, I've done a series of videos about depreciation and the different methods of figuring depreciation. But for the purposes of adjusting entries, I'm just going to tell you how much the depreciation is. And then later on, you can go through those depreciation videos and see how that gets determined. So when we're talking about depreciation, we're looking at a loss of value in an asset. And this is completely accounting based. It is not reality based. So when we're talking about depreciation from an accounting perspective, what we're looking at is estimating the life of that asset, how long we're going to be able to use it, and then we are recognizing that over time, from an accounting point of view, it's going to lose value and need to be replaced. We're using this asset up. So from an accounting perspective, we're starting out at what we paid for it, and then over time, we're going to decrease the value of that asset until it gets to zero on our books. That doesn't mean that it doesn't have value, that we couldn't go out and sell it. This is just a recognition of expense so that we are able to match up the use of that asset with an associated expense to recognize the accounting loss of value over time. So in this case, we bought a truck that we're going to use in our business. And let's say the truck was $10,000. So we're going to debit this asset in the original transaction for $10,000. We're calling this asset truck. You could call it vehicles and have all of your vehicles in that same category. You could call it property, plant, and equipment and have all of your assets within that category. In this case, we're a small business. We're going to call it truck. We might even call it, Ford F-350. Whatever it is on our books that's going to help us to keep track of that particular asset. So the original transaction, truck, we're increasing our asset for $10,000 and we paid cash for it, let's say, so we're going to decrease our cash by $10,000. So 1 month goes by after we put this truck in service. And we have determined through a mystical method that we'll talk about in the depreciation series, where we've determined that $1,000 is what our depreciation expense is for the month. So now we're going to use another new account called accumulated depreciation. So accumulated depreciation is an asset, but it is a contra asset, meaning it works the opposite of an asset. So if we want to increase it, we're going to credit it, and we're going to debit it if we want to decrease it. More on that later. So our adjusting entry is going to be depreciation expense, debit $100, and accumulated depreciation, credit of $100. Now let's look at what that looks like on our balance sheet, and this may come clear for you. So here on the snippet of our balance sheet, you can see that we have our truck asset listed at the cost, what we paid for it, of $10,000. After we do our adjusting entry for $1,000, debiting depreciation expense, crediting accumulated depreciation, we now see on our balance sheet minus $1,000. So our truck is still there at its full cost. We know what we paid for it. And our accumulated depreciation is going to grow as we month by month do these entries. So if our depreciation expense for the second month is $1,000, then this accumulated depreciation will go to a balance of $2,000. So we're going to keep track of this until we have fully depreciated this asset down to zero. Again, more about that in the depreciation mini-series. But on our balance sheet, we're going to see always the cost of the truck, and we're going to see this accumulated depreciation where we're keeping track of those depreciation expenses. So this is kind of like our counter, keeping track of how much we have depreciated this asset. So those are the typical expense-related adjusting journal entries that you will see. Now, in the last video of this series, what we're going to do is we're going to go through the entire process from the unadjusted trial balance to the adjusting entries to posting to the accounts to doing an adjusted trial balance and then doing financial statements. So join me for that because when you start to actually apply this is when it becomes clearer for you. So join me with that, and until next time, stay balanced, my friends. I want to start this video out with a special message for my subscribers. You are an asset to this channel, and I depreciate you a little bit more each month. Remember, I don't charge extra for the accounting humor. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence. Looking buff today, little buddy. Terrence joined a gym. In today's video, we're going to be talking about depreciation. This video serves as an overview of depreciation, and then in other videos in this playlist, we're going to get into how to actually figure depreciation based on 4 different methods. Now in this video, it's accounting depreciation that we're talking about here, rather than tax depreciation, which we'll have a separate video for. Now, before we can dig into the topic of depreciation, we have to start with the topic of fixed assets. So what's a fixed asset? You'll also hear it referred to as a long-term asset or as property, plant, and equipment. So these are assets that a business uses to create revenue, like a piece of equipment used in a factory or a factory building or a warehouse building, vehicles, gym equipment, office furniture, computers. So those are assets that we are planning to have for a period of time, 3 years, 5 years, 10 years, 30 years, and we're going to use those assets in order to create revenue for our business. So those assets lose their value over time. Let's take this piece of gym equipment, this bike that Terrence is riding here. You probably can guess that having a bunch of Tyrannosaurus Rexes using your gym equipment is going to wear it out pretty quickly. Nothing personal, Terrence, but you and your friends are a little bit rough on the equipment, okay? So as we use up an asset, it becomes an expense. And with a fixed asset, that expense is depreciation expense. So depreciation is about the allocating of an expense rather than the valuation of an asset. So coming back to the matching principle, what we want to be doing is we want to match the expense, the loss of value over time, to the period where the revenue is being generated. And that's different from what the asset is actually valued at in the marketplace. So we can buy an asset, completely depreciate it on our books so that its value is zero, but that does not mean it doesn't have value in the marketplace. So when we're talking about depreciation, we're only talking about the recognition of an expense. And when we're talking about depreciation, we're talking about estimates. So we're going to estimate the reduction in value. We're going to estimate how long we think this asset's going to last, its class life or its useful life. And we're going to estimate the salvage value, the residual value, what this thing is still going to be worth in 3 years or 5 years or 30 years. So it's all based on estimates. And that's an important point to realize as we get into the other videos where we're actually computing how much depreciation expense we're going to take each month. So we need to understand some terms. We need to understand what the cost is that we are recording our fixed asset at. And generally speaking, it's whatever we paid for the asset plus any costs that we had to incur in order to put that item in service. When is it able to start generating revenue for us? So let's say we buy a piece of equipment, but before we can start using it, we have to pay to have it shipped to us, or we have to pay our employees to go break the machine down, pack it up, and bring it back with them. Or we have to do some kind of modifications to that machinery before we can use it for what we need to use it for. So those are all examples of costs that we're going to include in the cost of that item. And we're not using what the item is worth in the marketplace. We are only looking at what we paid for it. So even if we got a really great deal and it's worth $30,000 more in the marketplace, we are only recording what we paid for that item and any costs incurred in putting it in service. So then when we talk about class life or useful life, the IRS has come up with groups of assets that have a 3-year life, a 5-year life, a 7-year life. So we have that guidance to go by. But we can also make a different estimate. So if we have a machine and we think it's going to last 5 years and the IRS is saying, we think it's going to last 7 years, we can use that 5-year amount because it's based on some sort of realistic estimate on our part. And then when it comes to salvage or residual value, what we're looking at again is an estimate. We are estimating that in 5 years, we would be able to sell this asset for $500. Or we're estimating that at the end of its life, it will not have any value at all. Maybe it's some sort of a computer program. Now, the next thing we need to understand about depreciation is a new account called accumulated depreciation. This is a balance sheet account. It is a Contra account. It is a contra asset, meaning it works the opposite of what a normal asset would do. So a normal asset would have a normal debit balance. We would increase it on the debit side of a journal entry and decrease it on the credit side of a journal entry. With a contra account, it works the opposite. Let's look at what that looks like once it hits the balance sheet. So here's a little snippet of a balance sheet. We have an asset that we paid $3,000 for. It has a 3-year life, and we're going to divide this expense, this depreciation expense, evenly over 3 years, just for simplicity. So in the first year, we're going to do an adjusting journal entry of depreciation expense, debit of $1,000 and credit of $1,000. In our little balance sheet snippet, now we can see that we have the cost of the asset. That's always on our balance sheet. And then below that, we're going to keep track of that reduction of value. So in the first year, we have a $3,000 asset. we have accumulated depreciation of 1,000 and a net book value, the value of that asset on our balance sheet, of $2,000. In the second year, we do the same adjusting journal entry, but now when we post that to our accounts, our accumulated depreciation is at $2,000. So we have the cost of our asset, $3,000, minus our $2,000 in accumulated depreciation, leaving us with a net book value on our books for that asset of $1,000. The third year, we're going to do our adjusting journal entry again for $1,000. When we post that to the accounts, now our accumulated depreciation is at $3,000. So we have an asset that we paid $3,000 for. We have fully depreciated it at $3,000. So now our net book value is 0. Now, had we had a residual value on this, we would have only depreciated down to that residual value. And again, this doesn't mean that just because it's worth 0 on our books, that it's not worth something in the marketplace. We could turn around and sell this for scrap, or we could trade it in on another vehicle, or sell it to another business. So all we're doing here is tracking the reduction of value so that we are conforming to the matching principle of GAAP. Now let's talk about what happens when we purchase a new asset. Let's say I'm a gym owner and for some inexplicable reason, I need to replace a bunch of exercise bikes. So when we purchase a new asset, we're going to add it to our chart of accounts. And we're either going to add it as its own fixed asset account, like for example, Ford F-350, or we're going to add it to an existing fixed asset account like vehicles or office equipment. So it can either be its own asset or it can be grouped in with other assets that are like each other. So when we do that initial transaction, if we're talking about accounting class, we would be doing a journal entry that would be something like debit to vehicles and credit to cash or credit to notes payable. If we were doing it in real life, IRL, as the kids say, do the kids still say that? Then we might be doing something like writing a check to the dealership, which serves to credit cash, and then the account that we would hit in the account line would be our fixed asset account. Now, if we have a note payable that goes along with that new asset, we would be setting that up as a long-term liability within our chart of accounts as well. So what happens when we get rid of an asset? We sell it, we scrap it, we trade it in. Well, at that point, we're going to remove it from the books because the business no longer owns it. So we do that usually through a journal entry where we're going to reduce the asset, we're going to zero out the accumulated depreciation, and we're going to record any gain or loss if we sold the asset in some way. So when we're talking about figuring depreciation, there are 3 different ways to do that. We can either do it in a straight line manner, meaning that we're going to divide it up evenly like we did in our equipment example with our $3,000 asset. So we divide it up evenly over the class life of that asset. Or we can do it in a variable method. So it depends on usage, like mileage or hours. So if we use an asset more in one year, we're going to take a bigger depreciation, or we use it less, we take less depreciation expense, or we do it in a way that is accelerated. So we're recovering more of the cost up front. We're taking a bigger depreciation deduction in the first year or 2. So some of the common depreciation methods that you'll run across are straight line, which we mentioned was divided evenly, declining balance, which could be either double declining balance or 150% declining balance, or we're taking more at the beginning, units of activity, which you'll also hear called units of productivity, where we're taking some sort of a unit, an hour, miles, and we're using our actual usage to determine our depreciation expense, or some of the year's digits. Now, those are book accounting, right? Those are for our accounting records. What we do on the tax side of things could be a completely different method. And because there's so much complexity with that, I'll do a separate video that does the overview of depreciation for tax purposes. So the choice of depreciation method impacts both the income statement because of depreciation expense and the balance sheet because of asset value. So the higher your depreciation expense, the lower your profit. The lower your depreciation expense, the higher your profit. We're also impacting accumulated depreciation, which makes a difference in how much our assets are worth on the balance sheet. So making those depreciation decisions in a business have a definite impact. Now, one thing that we never depreciate, even though it's a fixed asset, is land. So don't depreciate land. Don't do it. And if you're an accounting student, your accounting textbook will try to trip you up with that. Okay? Never depreciate land. So in our next videos for this playlist, we will talk about the 4 different methods that I mentioned for figuring how much depreciation to take and what the best practices are for taking that depreciation. So join me for those. Until next time, stay balanced, my friends.
In this video, we are going to visit opposite land. Like when you say to a toddler, yes, and the toddler says no. Or like your parents, you want them to be normal, but they want to sell the house and live in a van down by the river. That is the nature of contra accounts, and that's what we're exploring today. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my contrary sidekick, Terrence, and we are here to put the fun in accounting fundamentals. So when we talk about contra accounts in accounting, what we're talking about are accounts that are going to be paired with another account to offset the balance in that other account. Contra accounts work the opposite of the account that they're paired with. Stick with me on this. So a contra account is used to reduce the value of a related account when the two are netted together. So the purpose of doing a contra account rather than going right directly to the main account is we want to preserve the historical information that's in the main account, but we also want to represent the true value of the account by showing that the main account is not necessarily worth what we say that it is on our balance sheet. Let's look at a couple of examples. Now, if you've watched the Allowance for Doubtful Accounts Bad Debts video, you've already seen this in action. If you've watched the depreciation videos, you've already seen this in action. So when we're looking at our balance sheet, we'll have something like accounts receivable as our main account, and then we have Allowance for Doubtful Accounts as a contra account. When we net those two together, it gives us the true value of our accounts receivable account. When we have a fixed asset on our balance sheet and we have accumulated depreciation as a contra account, then when we net those two together, it gives us our net book value for that asset. So those are contra accounts in action. But let's talk about what those contra accounts are. So we have 5 major types of accounts in accounting. We have assets, liabilities, equity or capital, revenue, and expenses. Well, we can have contra accounts for any of those. So we can have a contra asset like allowance for bad debts. We can have a contra liability. We can have a contra equity account like withdrawals. We saw that in the first few chapters of our Accounting 1 journey. We can have a contra revenue account like sales discounts, and we can have a contra expense account. Now, you don't see contra expense accounts very often, but you can certainly have them under certain circumstances. So let's talk about some account pairings. So fixed assets, accumulated depreciation, notes payable, discount on notes payable, bonds payable, discount on bonds payable. Joe Smith Capital or Joe Smith Equity can have Joe Smith Dividends or Joe Smith Draw. Capital stock, treasury stock, revenue, sales discounts, revenue, sales allowances, revenue, sales returns. And under the expense side of things, what if you are getting reimbursements? So for example, if you have advertising expense, but you're going to get reimbursed by a third party for part of what you spend on advertising, then you could have an advertising expense contra account to keep track of that so that we know whether we've gotten paid for everything that we're owed. So when we use a contra account, it is going to behave the opposite of the account that it's paired with. So if it's an asset has a normal debit balance, so a contra asset would have a normal credit balance. If we're talking about a contra liability, a liability has a normal credit balance, so a contra liability would have a normal debit balance. Equity accounts, normal credit. Contra equity, normal debit. Revenue, normal credit. Contra revenue, normal debit. And expense, normal debit. Contra expense, normal credit. And once we've posted to those contra accounts, when we get to the financial statements, you will see the main account and then the contra account that it's paired with, and then the net value of that main account. So that's why we use contra accounts. We want to preserve the original data in the main account, but we also want to recognize that that may not be the overall true value of that account. And there you have it. Contra accounts explained. Until next time, stay balanced, my friends.
In part 4 of our mini-series covering adjusting entries, we're going to cover posting our entries to our accounts. We're going to create an adjusted trial balance, and we're going to use that information to create financial statements. If you haven't watched part 1, I'll link that up in the corner. I'd recommend that you start there. Otherwise, trauma, frustration, and weeping. And nobody needs that. Welcome to Accounting How To. I'm your host, Carolyn Grimm. That's my sidekick, Terrence, and we're here to put the fun in accounting fundamentals. Now, a lot of times when we're learning accounting, we're doing pieces, and it's hard to know the full picture because we're getting all of these different blocks of information. So as you're learning accounting, think of it as you're learning different blocks of information that you're then going to build into something. So it's like building a Lego creation, right? You're putting together this piece and you're putting together that piece, and then there's this piece over here. And then finally you bring them all together, and oh my goodness, you've just built an incredible Tyrannosaurus Rex. Don't let it go to your head, okay, bud? The next time you see me, I will magically pop up into a spreadsheet. It's one of my superpowers. So when we did this series of journal entries in the Analyzing Transactions video series, we started out with a chart of accounts. And I have this chart of accounts here. The items that are colored are from our first original chart of accounts. Now we've added on to this chart of accounts so that we have the accounts that we need to track everything for our business. So we've added on some assets. We added on prepaid insurance, inventory, truck, and our accumulated depreciation contra asset. We've added on some new liabilities. We've got our wages payable, we've got our unearned rent, and those will all seem familiar to you if you've done the second and third videos in this series. And then we've also added another revenue account. We added some rent revenue, and some new expenses have come along. We've got cost of goods sold, we've got utilities, wages, insurance, and depreciation expense. Now, it's absolutely fine to add accounts to your chart of accounts. Things change, you need to track something different, you buy a new asset, so you can always add on to your chart of accounts. Perfectly fine to do that. Now let's jump into our original journal entries. So in the second and third videos, I talked about how you need to understand what the original transaction was so that you can understand how it needs to be adjusted. And so what I've done here is I've kept all of our old journal entries from, these are the regular things that happened every day. Joe Smith started a business, put some money in, we bought some supplies on account. All of those items are here. But I've added on some transactions so that we have something to work with our adjusting entries. So here is the purchase of a truck, which we paid cash for. Here is a purchase of an inventory, which we paid cash for. And then here is us receiving rent from a customer. They are prepaying their rent. So for us, it is unearned rent because we have not earned that revenue yet. And then we have prepaid insurance because we have paid our insurance for the whole year. Now, one transaction that I took out of here was our supplies and supplies expense transaction, because when we talked about that in the Analyzing Transactions playlist, this was a typical transaction that you see in your first accounting class where they try to trip you up with moving things from an asset to an expense. And it's actually an adjusting entry. So I took that out so that we can start fresh here. So these are our journal entries that were the original entries. And this spreadsheet is going to be available for you in the description of these videos so that you can download it and you can go through it at your leisure, because I know sometimes it's not really a lot of fun to watch other people do accounting, but when you do it yourself, maybe it's more fun. Maybe? Okay. So from this point, we took our journal entries and we posted them to our general ledger accounts, which is this screen right here. So here are all of our accounts. We have posted each transaction. Here's our original transaction with our business owner. He put $55,000 into the business to open up a business checking account. So we're debiting cash by $55,000. And the other side of that transaction is here with Joe Smith's capital account. So we credited that $55,000. So all we've done here is we've gone back and forth between our journal entries and our accounts, and we posted each and every one of those into those accounts. And then we have kept a running balance of all of those accounts. So when we finish up on June 30th, the last day of the month rolls around, we have updated balances for all of our accounts. And that's the point that we're at right now. From there, we took that information into what we now know of as the unadjusted trial balance. So all we've done here is we've pulled our balances. Here's our cash balance of $26,730. We've pulled it over here to our cash account line of $26,730. So all we've done is we've pulled all of those balances here. If they're credit balances, they go on the credit side. If they're debit balances, they go on the debit side. And then we are checking to see that our debits equal our credits, and they do. Fantastic. Love it. So this is our jumping off point for doing our adjusting entries. So here we go. Here are the adjusting entries that we talked about in the second and third videos. So the first one is that we have fees earned but not yet billed to the customer for $12,000. And this is the example that I used of with my business. If I have a project that carries from one month to another month, then I have revenue in that first month. And even though I haven't billed my customer yet, I still need to recognize that revenue. So in this case, Joe Smith has done whatever Joe Smith does, and he has fees that he has earned, but he's not yet billed the customer for $12,000. So our adjusting journal entry is accounts receivable, $12,000, debit, and fees earned, our revenue account, for $12,000. Then we had wages that we owe to our employees. They've earned the wages, we've incurred the expense, but payday doesn't happen until next month. So we debited wages expense for $5,000, credited wages payable for $5,000. And then we had 1 month's rent that was used for our tenant, $3,000. So it's currently sitting in unearned rent. We want to take it out of there. So we're going to reduce that liability account by $3,000. And we've now earned that rent, our revenue. So we're going to increase that by $3,000. This is the transaction that I took out from our original set of transactions for the Analyzing Transactions video series. And now we're putting it back in. It's the same transaction. We used $2,050 of supplies in June. So it's sitting in our asset account called supplies. We've used up some of that. So now we're going to move it to our supplies expense. So we're going to debit supplies expense by $2,050, and we're going to reduce our supplies asset by $2,050. Now, previously we had prepaid for a year's worth of insurance. Now we have used up 1 month of that insurance. So we're going to move from prepaid insurance into our insurance expense. So we're increasing insurance expense and we're decreasing our asset called prepaid insurance. And then we said we needed to book our depreciation for the month. And we determined that 1 month depreciation on our truck is $100. So we're going to increase depreciation expense by $100, and we're going to credit our accumulated depreciation contra asset for $100. Then we had inventory that we purchased, and we used $1,300 of that in the month of June. So we need to move that out of our inventory account by crediting our asset for $1,300, and we need to move it into our new expense account called cost of goods sold for $1,300. So we're increasing our cost of goods sold. And then in the final transaction, we had utilities expense that we incurred, but we have not received the bill yet, and we're estimating that bill is going to be $600. So because of the matching principle, we need that expense to be in the same month with the revenue that it earned. So we're going to debit our utilities expense by $600, and we're going to credit our accounts payable by $600. So we're going to take those accounts, and then we're going to bring them over to our general ledger, and we're going to put those into each one of those accounts, just as we did with our regular journal entries. So we're going to debit accounts receivable. We'll come over here, accounts receivable, we're debiting accounts receivable. Now the one difference is, up till now when we've had this item column, we have left that blank. So now what we want to do for adjusting entries is we want to put the word adjusting next to those entries. And this helps us when we're looking at our accounts to pick out those adjusting journal entries easily. So I've gone through and I've posted all of those adjusting journal entries in the accounts in which they belong and updated the balances. So the next step is to do an adjusted trial balance. And all we're doing here is taking our newly updated balances and bringing them into a new trial balance called an adjusted trial balance. So here's our original trial balance, which we now know is our unadjusted trial balance. And here is our adjusted trial balance. So you'll see, for example, that accounts receivable has changed. It was $3,800. It is now $42,800 because of the entry that we did for the customer that we billed. Our supplies number has changed. It's gone from $3,300 to $1,250. So all of those balances have been updated, and it gives us at the bottom, hopefully, we will be in balance, and we are. Once we get to this point, this is the point where we can actually go and do our financial statements. So just to recap, we had our original journal entries, we posted them to our accounts, we did our unadjusted trial balance, we did our adjusting entries, we did our adjusted trial balance, and now we get to do financial statements. Woohoo! So everything that you need to figure out your financial statements is right here in this adjusted trial balance. So let's jump over to this screen and take a look at that. So here I've done a really simple, not prettied up income statement, statement of owner's equity, and balance sheet. So where are we getting our revenue? Well, we're getting it right from our adjusted trial balance. Here it is right here. We've got fees earned of $61,100, and we've got rent revenue of $3,000. So here we've added those up so we know what our total revenue is. It's $64,100. And then we've pulled over all of our expense amounts, giving us total expenses of $27,930. We take our total revenue minus our total expenses, and that gives us a net income or profit of $36,170. Now we need to do our income statement first because that information then gets pulled into our next piece, which is our statement of owner's equity. So in our statement of owner's equity, because this is a new business, we started out with beginning owner's equity of 0. And what we're looking at here is what is the change in the value of the owner's equity. So we started out at 0. The owner made investments totaling $55,000. The owner had withdrawals of $18,300, and we had a net income. Net income increases equity, right? The owner has more value in his business because he had a profit. So we bring this over here into this account called retained earnings. Retained earnings is simply taking this month's profit or loss, next month's profit or loss, the month after that. It will be an accumulating number. But in this case, this is the first month that we're in business. So our retained earnings is the same as our profit for the month of June. So we bring that over here. We take our beginning balance plus our owner's investments minus our owner's withdrawals plus or minus our profit or loss gives us our ending owner's equity. When we come around to the month of July, our beginning owner's equity is going to be $72,870. So now let's jump over into our balance sheet. So in order to do our balance sheet, we first needed to get our net income, which then carried over to our statement of owner's equity, and then that carries over to our capital, our equity accounts on the balance sheet. So in the first column, we have our asset, and we're pulling those asset amounts right from our adjusted trial balance. Here are our assets right here, this batch right here. And then we're doing the same thing for our liabilities. We're pulling those over from our adjusted trial balance. And then our equity numbers are coming from both our adjusted trial balance and from our statement of owner's equity, pulling over that retained earnings piece. And our balance sheet closely mirrors the accounting equation, assets equal liabilities plus equity. So that's the whole process that we go through in order to get from our original journal entry transactions all the way through to doing our financial statements. And again, this spreadsheet will be in the description, so you can download it and go through it at your leisure. Until next time, stay balanced, my friends. What if there was some tool that could help you understand exactly what was going on in a business? Like maybe some reports or something that could open up a magical door of understanding. Well, we've got that kind of magic here for you today. It's time to pull back the curtain and reveal the mysteries. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. Let's jump right in. So the first thing we need to talk about is, why is accounting important? And I run into this a lot in my accounting practice, where business owners who are perhaps less experienced don't understand why the accounting function is important in business until they get into trouble. And then suddenly they realize that this accounting thing is important. And accounting is important for a variety of reasons. One is that we have a compliance issue here. We have to report to government agencies like the Internal Revenue Service. We have to report financial information to outside entities. If we want to get a loan from the bank, we need to be able to give the bank solid information about how our business is performing. And then on the internal side, we need to understand the number side of our business so that we know whether we're making money or not, or we can see problems as they arise before it's too late. So we do all of those things by collecting all of our transactions, and then we summarize them into these things called financial statements. And the financial statements tell us everything that we need to know about the health of our business. So think about it in terms of being in the hospital, and the nurse comes in every 3 hours, 4 hours, whatever it is, to check your vital signs. And that's what accounting is doing. It is collecting the information that we're going to use in order to see trends or to make sure that we are not getting ourselves into a cash flow situation. So financial statements are like the chart that your doctors and nurses keep on you while you're in the hospital to make sure that you are progressing in a good way. So those summaries of all of those transactions that make up these financial statements are each showing us a different picture of our business. So the 4 financial statements we're going to touch on are the income statement, which you'll also hear called the P&L, and the second one is the statement of owner's equity. The third is the balance sheet, and the fourth is the statement of cash flows. Now, each one of those is going to tell us a different part of the story of our business. So let's use as an example a simple business. Let's say that you live next door to a campground and you have a little shed set up for selling firewood to campers. And every time you purchase firewood from your supplier or you sell firewood to a customer, you have a transaction. And that transaction causes changes in the financial picture of your business. Now, when we're talking about each of those financial statements, I said they each show a different picture of your business. So you can think of your income statement as your scoreboard. And what this is going to show you is how much you've sold to your customers, your revenue, and how much it cost you in order to sell to your customers. So, for example, we had to buy firewood in order to sell it to our customer. So, we're going to track those expenses that it took for us to make the money that we made on selling firewood. And that's what your income statement is going to show you. It's going to show you how much you earned, your revenue, and how much your expenses were. When we take our revenue minus our expenses, it shows us our profit. Did we make any money? If we sold $1 worth of firewood and we spent $1 to sell that firewood, then we have zero profit. If we sell $2 worth of firewood and it costs us $1, now we have $1 of profit. So that's all our income statement is saying. Are we actually making any money doing what it is we're doing? Now, the statement of owner's equity, you can think of this as your stake in the game. So how much is what you own in your business worth? So if you are the only owner and you have a situation where you are putting money into the business, you're then expecting to get money back out of the business at some point in time. So your statement of owner's equity is basically showing you what your business owes you. Okay, so anything you've put in order to make the money, your business owes back to you. Now, the balance sheet shows you what the value of the business is. It's going to look at three things. It's going to look at your assets, your liabilities, and your equity. Hey, look at that. Assets equal liabilities plus equity. So it's going to look at what you own on one side and what you owe on the other side. So your liabilities are what you owe to your vendors or to the bank or to your credit card company. And your equity is what the business owes to you. So your assets, what you own, equal what you owe. And it depends on how much you owe on the liability side as to what the value of your equity is in the business. The fourth financial statement is the statement of cash flows. And the only thing that the statement of cash flows cares about is cash. It wants to know where the cash came from and where the cash went. So what it looks at is, what did you bring into the business from your operations for cash? So let's say you brought in $2 in revenue in cash from your business, and you spent $1 in cash on expenses. So you have a net increase in your cash of $1. So your statement of cash flows is going to break things down based on three different categories: operations, financing, and investing. And we will get into that more in depth when we do the statement of cash flows video. But statement of cash flows basically walks backwards through your checking account and says, okay, we made a deposit here and we had money going out of the checking account there. So that's all it cares about. It doesn't care about profits. It only cares about cash. And the reason that this is important is because the cash is the engine that keeps your business going. If you do not have cash, it doesn't matter whether you're making a profit, because you've got to have cash to pay your employees, to buy materials. All of those things have to have cash. And so that's why that statement of cash flows gives us another picture of your business. So when you take all four of those financial statements, your income statement, your statement of owner's equity, your balance sheet, and your statement of cash flows, You bring together a great picture of whether your business is healthy or not. And what that gives us the opportunity to do is to say, hey, our business is doing really well right now, or our business is struggling right now. And where are the areas that it's struggling that we can then make them better? But it also gives you the opportunity to compare. So you can compare how you're doing this month to how you were doing in the same month last year. Are you doing better or are you doing worse? You can compare this year compared to last year. So it begins to give you this track record where you can see how your business is progressing, where it's struggling or where it's succeeding, and then there are opportunities within those items where you can make improvements to your business. So if it's running well, it can run even better. Or if it's not running well, you can figure out why and start to work on those things. So when you add all of that together, it gives you a really great tool to understand a business. And it doesn't matter whether you are the business owner or you're an accountant or a bookkeeper, or you're an accounting student who is having to do some comparisons between a company's financial statements. It's all the same thing. So you can walk into any company and take a look at their financial statements and understand what's going on with them. Now, the way that we get to having actual accurate financial statements is to work through the magical structure of accounting to record the daily transactions. And that structure of accounting is based on the accounting equation. The increases and decreases that we track within that equation create changes in the financial statements. So we've got assets equal liabilities plus equity. So in the case of our firewood business, our assets would be things like cash, our firewood inventory, our shed. Our liabilities would be anything we owed to our firewood vendor or the supplier of the strapping that we use on our firewood. And then equity is the difference between the two. While we're talking about camping, funny story. I took Terrence camping once, sort of a, team building exercise because I'm a good boss like that. It turns out he's afraid of snakes and he refused to get out of the car. I mean, I get it, but it was this little teeny garter snake that was racing away from us as fast as its little feet could take it. But anyway, if you want to get into more depth about financial statements, check out my financial statement playlist in the description. And if you want to get into all the nitty-gritty details of how transactions work, check out my Accounting Basics playlist. It'll take you through absolutely everything you need to know. Until next time, stay balanced, my friends.
In today's video, we are going to explore the mystical income statement, also known as the profit and loss or the P&L. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence the T-Rex, and we are here to put the fun in accounting fundamentals. So in today's video, we're going to start with a very simple income statement, and then we're going to add complexity to it so that by the time you're done, you can look at any income statement for any business of any size and get a good idea of what's going on with that income statement. So let's dig into a spreadsheet. It's my favorite. So here we're looking at a very simple income statement. It's revenue minus expenses equals profit or loss. Now in this case, what we're looking at is a cash basis income statement. And if you need to know more about cash basis versus accrual basis, I will link that video in the description so you can check that out. So the basics of a cash basis income statement is that we count the revenue when we receive the cash, and we count the expenses when we disperse the cash, when we write the check. So in this case, we have a business that has $10 in revenue and $4 in expenses, which gives us a profit of $6. So that is the basic income statement. And all we're doing from this point forward is just adding details so that we can get more details about what the health of the business is. And now we want to add some details to that basic revenue minus expenses equals profit or loss equation, because we want to know more about what those specific accounts are. What are the revenue accounts that we are looking at? What are the expense accounts that we're tracking? So in this case, continuing along with the cash basis, we now have two revenue accounts. We have a sales revenue account and a subscriptions revenue account. And we've detailed how much revenue we have for each of those, and then added a total revenue line. And then under the expenses, we've added a couple of expense accounts. We've added advertising expense and telephone expense, and a total expenses line. And still, when we take our total revenue minus our total expenses, we're still looking at profit or loss. So none of that has changed. All we've done is add some detail. Now let's look at an accrual-based income statement. We've moved away from cash basis. Now we're looking at accrual basis. And under accrual basis accounting, we have revenue when we've earned it, regardless of when the cash comes in. Once we've earned that revenue, that's when we're going to claim it on our income statement. We're going to recognize that revenue. And on the expense side, we have an expense when we have incurred it. Not when we've paid it, but when we've incurred the expense. So we used electricity, or we've signed a contract for advertising expense. So it changes the way that we book things, but it doesn't change the structure of our income statement. What it does do is it changes the structure of our balance sheet. So if you look at the income statement, everything has stayed the same. But what we've done is we've added on the balance sheet a couple of accounts to help us track the money that's owed to us or the money that we owe to our vendors. So now we've got accounts receivable and we've got accounts payable, and that helps us to track these accruals. So now we have a place to keep track of the fact that we sold to a customer, but the customer hasn't paid us yet, or that we have incurred an expense, but we haven't paid the bill yet. So that's what's happened now under accrual basis. We've added on a little bit, but it hasn't impacted our income statement. Now, what about a merchandising business like Walmart or Amazon? So in this case, now we're going to add on to our income statement. We're going to add another detail. And that detail is going to be a cost of goods sold account or a cost of merchandise sold account, depending on what the company is using for an account name. And this is to account for the inventory that we are selling to our customers. So this also gives us a new line on our income statement called gross profit. And gross profit is the difference between our total revenue and our cost of goods sold or cost of merchandise sold. So this is going to give us that specific information about what it costs us to get the stuff that we sell to our customers. And that's a number that we would want to keep really close track of, because a 1% increase in our cost of goods sold would make a difference in our profit. And it also lets us know what we have for gross profit that we can then spend on our other expenses. So it adds a little bit of detail. And that's all we're doing here, is we're adding more detail so that we have a clearer picture of our profit and loss. Now on the balance sheet side, we're now going to add another detail there. Because we are buying inventory, we're going to have an inventory account on our balance sheet, a new asset account. And that inventory is where we're going to put all of the stuff that we're buying. And then as we sell it, we're going to move it into cost of goods sold. Now, what if we have a manufacturing business? We're buying raw materials and turning them into something that we then sell to our customers. The structure of the income statement stays the same. We're still going to have that line for our cost of goods sold. What changes on the balance sheet, though, is we're now going to have some inventory accounts where we're going to keep track of our raw materials inventory, our work in process inventory, our work in progress inventory, and our finished goods inventory. So we're going to track our inventory through each stage, and then as we sell it, we'll move it out of our finished goods inventory account and into our cost of goods sold account. Everything else stays the same as far as the income statement goes. Now let's say we want to start to categorize some things on our income statement. Well, now we can use something called a classified income statement. We are classifying different groups of accounts so that we have a better idea of what's going on with our business. So what we can do in that case is we can start to separate out things like administrative expenses and selling expenses, or we could group different types of revenue. But also what we can do is we can add some details below what was before our net income or our profit and loss line. So we can break down our income statement by what is just our operating income. And what that means is that we're going to take our revenue from operations, whatever it is we're doing, whether we're selling a service or we're selling goods to a customer, and then we're going to look at the expenses that go along with creating and selling that product, and then we can segregate all the other stuff that goes along with running our business. For example, if we have a loan where we're paying interest on it, we're now going to drop our interest expense down below that operating income line. And the reason for that is because if we sold our business to someone, what they want to know is this business making money? Like the revenue minus the expenses in what we do day to day, is that making money? And all of the other stuff we push down below the line, the other revenue, the other expenses. So we would have things below that line like interest expense, interest income. If we sold an asset and we had a gain or a loss on the sale of that asset. If we discontinued operations at one of our plants or one of our stores, and that had an impact on our income and expenses. Those things get dropped below the line because they're unusual or they're outside of what we do on a day-to-day basis, selling our service or our goods and the expenses that go directly along with that. So all we're doing here is adding some more details. Now, what we can do with all of this information that we're collecting in our income statement is we can do what's called a comparative income statement. And with a comparative income statement, we're going to compare different time periods in our own business. We can look at what happened this month versus what happened last month, or we can look at how we did this year compared to last year, or we can compare first quarter to second quarter. So it opens up an opportunity for us to really get some good historical data on our own company. But the second use of this is to do a comparative income statement with our business compared to another business, or our business compared to the industry average for our industry. And that's where you can really start to see the value of having this historical data for your business or for other businesses. So if you're looking to invest in a business, you can look at two businesses side by side. Or if you want to grow your sales 10% over last year, you know what those numbers are because you can compare. And then you can also forecast based on that information to say, well, if we want to grow our sales 10%, then what do our sales need to be next year in order for us to get there? And then what do we need to do month to month in order to keep going towards that goal? So there's a tremendous amount of value that's built into the income statement. And now that you have the key that unlocks it all, you can look at any income statement and get a really good idea of what's going on with a business. So until next time, stay balanced, my friends. In today's video, we're going to be talking about the E in the accounting equation. It's all about equity. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence, the T-Account Rex. And we're here to put the fun in accounting fundamentals. So today we're talking about one of the four major financial statements, the statement of owner's equity. Now, the statement of owner's equity, the first thing you should know about it is that the name can change based on the types of ownership involved. So for example, if you have a sole proprietorship, then you might hear it called the statement of owner's equity. If you're talking about a partnership, it might be called the statement of partner's equity. If you're talking about an LLC, it would be called a statement of members' equity. If you're talking about a corporation, you would be calling it either the statement of stockholders' equity or the statement of shareholders' equity. Now, you may also hear it called by another name. You might hear it called statement of changes in owner's equity. And therein lies the secret to understanding this report. What we're tracking is increases and decreases to the value of an owner's equity in the business. And it doesn't matter whether it's a shareholder or a partner or a sole proprietor, we're looking at changes in equity. What did you start out at and what did you end up at? Now, with the use of accounting software, the statement of owner's equity, whatever you call it, doesn't need a lot of attention for smaller businesses. If the software is set up correctly, everything happens in the background and small business owners wouldn't even really notice that this report exists because the information pulls through directly to the balance sheet without any intervention on our part. For large corporations, more details are needed, and the accounting system needs to be more complex to handle those details. Rather than having one owner, a corporation may have hundreds or thousands or millions of owners. So what we'll do next is we will jump into a spreadsheet and we will look at how the report changes based on the type of ownership a company has. So stick with me and pop on over to the spreadsheet. The first type of business that we want to look at is a sole proprietor. It has one owner. So what the statement of owner's equity is going to do is it's going to start with the beginning balance. So in this case, let's say we have a beginning balance of $10,000. And where does that come from? It comes from our ending equity for the previous period. So last month's ending equity becomes this month's beginning equity. So we've got $10,000 that we're carrying over from last month. Now in this month, let's say that our owner invests $2,000 in the business. And let's say that he or she pulls out $1,000. So they're taking $1,000 out of the business. And then let's say that we have a net income of $1,000. So the changes in the owner's equity are the investment, the owner has put more money into the business, the withdrawal, the owner has taken money out of the business, and the net income has increased the value of the owner's equity. If it was a net loss, it would decrease the value of the owner's equity. So we have a total change in equity of $2,000. $2,000 in, $1,000 out, another $1,000 in from the net income. So that gives us an ending inventory balance of $12,000. Now, when the statement of owner's equity pulls into the balance sheet, what you will see is a summary of what happened with the equity during whatever period of time we're looking at. And what we're measuring is how has equity changed. Now let's take a look at a partnership. Now a partnership is going to be a little different because we need to keep track of more than one person. Each partner is going to have their own equity account and each partner will have their own withdrawal or drawing account. And it's the same thing with an LLC, a limited liability company, only instead of calling them partners, we're going to call them members. But the same thing applies here, that we would have an equity account for each member and a withdrawal account for each member. Now the way that we figure those changes, the formula is the same. We're going to be looking at, did the owners put in investments? Did they take out money? Did they take withdrawals? And was there net income or loss? And then for partnerships and LLCs, because of their partnership or LLC member agreement, the partners or members can set up their own plan for how they're going to divide out their net income or divide up their net loss. So one partner could get a larger percentage and another partner could get a less percentage. And that's all based on their partnership agreement. So because we're keeping track of multiple partners or members here, we would do something like this to keep track of the capital accounts and the withdrawal accounts for each partner or member in the partnership or LLC. And what we're doing is we are tracking the increases and decreases in the value of equity for each one of those partners or members involved. Now, where things get a little more confusing is when we have a corporation, and particularly a corporation that is selling stock. So we would expect to see a bunch of different equity accounts that go along with our shareholders or stockholders. So we would expect to see common stock, additional paid-in capital common stock. And don't get hung up on these terms yet. At this point, these are just different types of equity accounts. and we will be going more in depth on these different topics in other videos. We've got some preferred stock, we've got additional paid-in capital on preferred stock. We might have other income or loss for things that are not normal part of our operations. Retained earnings, and retained earnings is an account that keeps track of all of our income and expense over whatever length of time the business has been in business. We might have a cash dividends account, a stock dividends account, and a treasury stock account. Now, because we have so many different accounts and each one of those accounts can change during a month or a year, we need to keep track of those changes. And we could do something that looks kind of like this. So here are our different categories, our different accounts. We've got common stock, we've got our additional paid-in capital, preferred stock, additional paid-in capital, preferred stock, other income or loss, retained earnings, our treasury stock, and then a totals column for all of those different pieces. And then on the left-hand column, we're going to spell out what those changes were. So for example, we had net income. Well, net income gets added to our retained earnings, which is an account that keeps track of all of our net income and net losses. So we're going to add that to our retained earnings column. And then let's say we issued some stock, and we issued $1,000 worth of stock plus $1,500 of additional paid-in capital. And then let's say we had some cash dividends. Well, dividends come out of our retained earnings account. That is where dividends are dispersed from. So we're going to reduce our retained earnings because we're now paying this out. It's no longer going to be in the business because we are paying it out to our stockholders. And then let's say we also had a stock dividend. Owners are taking a withdrawal, but they're taking it in the form of stock. So we're reducing our retained earnings by that amount. And then we also had a purchase of treasury stock. So treasury stock is our company stock that we've previously sold, and then we purchased it back and we're holding it in our business. This is a Contra equity account. So it acts the opposite of the parent account, the equity. And I'll link in the description my video for Contra accounts if you need to dig into that a little deeper. And then we also had a sale of treasury stock. So we're no longer holding on to this stock. We've sold it to someone. So that stock is with shareholders again. So we're going to reduce our treasury stock by $8,000, the value of the stock that we just sold. So when we total up those columns, you can see that our equity for the period of time that we're looking at, which is a month, went from $160,000 to $199,500. So what we've done is we've tracked the changes in our shareholders' equity, and then this would get pulled through to our balance sheet. So the important thing to remember with statement of owner's equity is that it's going to be set up differently for different types of businesses, and we're going to track different types of information, but it all comes down to tracking changes in owner's equity. And there you have it, statement of owner's equity. And be sure to check out the other videos for financial statements. We've got one for income statement, balance sheet, and statement of cash flows. Until next time, stay balanced, my friends. In today's video, we're going to be exploring the balance sheet, and that's going to put us back in touch with our dear old friend, the old accounting equation, A equals L plus E. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that is my sidekick, Terrence, who is always in balance, just like our balance sheet. And we are here to put the fun in accounting fundamentals. So we're going to jump right into a spreadsheet today, and we're going to take our balance sheet from very basic to more complicated so that you can take your knowledge of the balance sheet and you can apply it to any business and understand what's going on with that business. So we're going to start out with a very basic balance sheet, and the balance sheet mirrors the accounting equation. Assets equal liabilities plus equity. And of course, I'll link the accounting equation video in the description so that you can check that out if you haven't seen it yet. So on the top part of our spreadsheet, we have a very basic balance sheet. We have our assets, we have our liabilities, and we have our owner's equity. So those are the three sections of every balance sheet. We add on details, but this is the fundamental balance sheet right here. We're looking at our assets, our liabilities, and our owner's equity. Now, depending on what type of business this is, whether it's a sole proprietorship or it's a corporation, that owner's equity piece may be called different things. So it could be called stockholders' equity, or it could be called members' equity if it's an LLC. It could be called partners' equity if it's a partnership. But for the purposes of this video, starting out, we're going to call it owner's equity. Keep it simple. Now, if we look down below that, you can see the beginnings of what a balance sheet looks like. So we're going to have assets on one side and then liabilities and equity on the other side, just like we do in the accounting equation. But this format could also be a top to bottom format where we have our assets in one section and then below that a section for liabilities and equity. It's the same thing, just a little bit of a different format. So in this case, we're looking at a cash basis balance sheet to start, because there are some differences between cash basis and accrual basis balance sheets. So I've put together a little example here. I'm saying that we have assets of $100. We have liabilities of $40. The difference between the two is $60, which is our owner's equity. You'll see that both sides always have to be in balance, which is what we've talked about always with the accounting equation, always has to be in balance. And under the cash basis method for accounting, we count revenue when it's received and we count expenses when the cash is dispersed. So that's different from accrual. So when we're talking about the balance sheet for cash basis, there are some things that don't happen. So let's take a look at a little bit of detail for our cash basis situation here. So let's say that we want to add on some accounts here. We're not just going to lump everything into assets or liabilities. We're going to spell out which accounts we're talking about. So in this case, we're going to say we've got an account called cash and an account called inventory. And those two amounts, the 60 for cash and the 40 for inventory, give us our total assets. And on the liability side, you'll see that there's nothing there. Well, why would that be? Don't you have accounts payable? Well, under cash basis, we don't really have accounts receivable, accounts payable, because we only count those things when we actually receive the cash or disperse the cash. So under true cash basis accounting, you would not have those accounts. But you can use something called modified cash basis, where you would include accounts receivable and accounts payable. And this would be for smaller businesses that are on a cash basis. Let's switch over now to accrual basis accounting and our accrual basis balance sheet. So under our accrual basis balance sheet, we are going to have things like accounts payable, notes payable, accounts receivable. And you'll see that reflected here. So we've got cash, we've got accounts receivable, inventory, and now we've got a vehicle as well. So our total assets are now $160. On the other side of the equation, we have our liabilities and equity. In this case, we're saying we have accounts payable and notes payable that give us a total liability of $60. And the difference between the two, your total assets minus your liabilities, gives us that owner's equity amount. Well, now let's look at a merchandise business. And really that's what we were talking about in our last example, because there was inventory. So for a merchandising business like Walmart or Amazon, we're going to have inventory. And if we're selling on account to our customers, we're going to have accounts receivable. On the liability side, we're going to buy things from our vendors. We're going to pay them later. We're going to have an accounts payable. If we have a note payable, for example, on our vehicle, that's going to turn up here as well. So those things don't really change for this merchandising business. And the biggest difference is that inventory amount. Now, if we're talking about a manufacturing business has one more piece to this. So we're going to take our inventory and we're going to break that out by raw materials inventory, work in process or work in progress inventory, and finished goods inventory. And those finished goods inventory, that's what we have available to sell to our customers. But until it sells, we're going to keep it here on the balance sheet and not move it until it actually sells, when we'll move it to our cost of goods sold. So everything else has stayed the same for a manufacturing business. We've just added on those additional inventory accounts so that we can keep track of things as it moves through our factory. Now, in our previous examples, what we've done is we've kind of lumped things together, assets, liabilities, equity. But now what we want to do is something called a classified balance sheet, where we're going to add some categories to this. And we do the same thing on the income statement side. We start to add some classifications, some categories, and it helps us with doing financial ratios and to just really get a quick glimpse of what's going on with a business. So in this case, we've added a line for current assets and fixed assets, also known as long-term assets or property, plant, and equipment assets. On the liability side, we've added a section for current liabilities and a section for long-term liabilities. And then our owner's equity, we've broken that out into some additional accounts. So what we're doing here is we're just trying to get a clearer picture of what's going on in our business. So when we separate out current assets, we know that we have things that are liquid or close to liquid, meaning they're either cash or they can be turned into cash quickly. And that gives us a certain picture of the business. Is the business ready to pay its bills? Is it able to meet its obligations? And then we separate out our fixed assets because we need some more detail there. We need to have an accumulated depreciation account that goes with each of our assets or each group of our assets. So we start to build out a better picture of this business. On the liability side, by separating out our current liabilities, we can look at that very quickly and say, okay, let's look at our current assets compared to our current liabilities. Do we have enough liquid cash to cover our current liabilities? Can we pay our accounts payable? And we can look at this very quickly and say we've got $110 in current assets and we have $40 in current liabilities. So yes, we should be able to cover our accounts payable. Very helpful to know that ahead of time. We can also look at our long-term liabilities and make some determinations as to how much money we're going to need to make those payments as well. And then on the equity side, we've started to separate things out. We've got now an owner that we are assigning this equity. This is a one-owner business. So we've got Joe Smith equity or capital with $110. And then we've got Joe Smith withdrawals. This is money that he has taken back out of the business for $20. So he now has total equity of $90. We add that to our total liabilities of $60. Gives us $150. So you can see as we start to classify things, break things out, that it opens up the door for doing some really great financial ratios, financial analysis, and it becomes a much better tool for running our business. Now, as an accountant, when I walk into a new business and I'm looking at their financial statements, one of the first things I'm going to look at is I'm going to look at their accounts receivable versus their accounts payable. So what do our customers owe us and what do we owe to our vendors? So in this case, we have $10 in accounts receivable and we have $40 in accounts payable. To me, that would be a point of concern. Like we don't have enough in accounts receivable coming in order to pay our accounts payable, which means we have to rely on our cash. So the theory is that your customers would be paying you about the same time that you need to pay your vendors. Well, if you don't have the money in accounts receivable, or you have customers that aren't paying on time, then you're going to end up having to pull your accounts payable from your cash. So now you've got less cash, you may have a problem making payroll, so you can see where it starts to give you some interesting information about a business. But if we're just looking at this current balance sheet, it doesn't give us any kind of background or any kind of comparison in order to say, are we better off or worse off than we were a year ago? So that's where comparative balance sheets come in. So in this example of comparative balance sheets, what I've done is I've taken our previous classified balance sheet and I've just plunked it over here and called it current year. So the current year picture is what we just looked at. We've got $60 in cash, $10 accounts receivable, $40 accounts payable. If we just looked at that, we have no idea how this business is doing other than, it's okay, I guess. But we don't really know. But if we add to it last year's balance sheet at the same time, we get a very different picture of this business. So a year ago at this time, let's say we had cash of $1,200 compared to our current cash of $60. That's a huge change. So if I'm an accountant or someone looking to invest in a business and I look at that number, I'm like, what's going on there? We also see that our accounts receivable was a lot higher. Those are really the only two things besides equity that I've changed in this picture. But you can see that just those two numbers give you an entirely different picture of what's going on with this business. Why is it that a year ago we had $1,350 in cash and accounts receivable, and now we have 70. So now you see there's a red flag that goes up. What's going on with this business? We need to dig into this and find out what happened. So anytime you see a big change in a company's balance sheet like that for any of these accounts, it raises questions. And those are the questions that can give a business owner better understanding of a business. And if the numbers have gotten worse, you can look at how to improve those numbers. Or if the numbers have gotten better, you can look at how you can take advantage of that and do more of whatever it is that's leading to that. But you can also take this same information and use it to compare 2 different companies or 3 different companies side by side. So if you're looking for a business to invest in, so when you're looking at more than one business side to side, you can start to see the strengths and the weaknesses in those businesses as compared to each other. You can also take the same information and compare it to industry standards, benchmarks, so that you can see if your business is operating as efficiently, as profitably, as another business in the same industry about the same size as yours. But that is the power of having good financial statements. The whole reason that we do all of those nitty-gritty accounting things is to get these financial statements. And then we use these financial statements to actually run the business and understand what's going on. And then we can use that information to help us run a better business. So my hope with this video and with the other financial statement videos is that you can now take these concepts and apply them both to your business, your clients' businesses, or to businesses that you may be interested in investing in, and you'll have this great tool to work with. So until next time, stay balanced, my friends.
Remember that old song, Cotton Eye Joe? Where did you come from? Where did you go, Cotton Eye Joe? Well, today we're going to talk about the Cotton Eye Joe of accounting, the statement of cash flows. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. We're here to put the fun in accounting fundamentals. So what we want to talk about today is the 4th major financial statement, which is a statement of cash flows. So statement of cash flows cares only about one thing. It cares about the cash, the Benjamins. It wants to know, where did the cash come from and where did it go? So we're going to look at this in terms of buckets. And if we were looking at our cash bucket, all of the cash would come into the bucket and then the cash would go back out of the bucket. It would come in from our customers, it would go out to pay our bills. But when we're talking about a business, we want to know specifically what areas of the business are producing cash and using cash. So we talk about this in terms of sources of cash and uses of cash. So what we're going to do is we're going to divide our cash into 3 different categories so that we can learn some things about what's going on with our business. So the first bucket that we are going to look at is going to be operating. The second will be investing, and the third will be financing. So we're going to sort our cash into those 3 different categories. Now, the operating bucket is all about the day-to-day stuff that goes on in a business. So we sell stuff to our customers, we pay our bills. That's all going to be dumped into this bucket called operating. The investing bucket is going to look at the big stuff, like did we buy a building? Did we invest in a new piece of machinery? So we're going to look at where the cash came from and where the cash went with investing. And then we're going to look at financing. So did we take out a loan? Do we have loans that we're paying on? And that's going to tell us another piece about the health of our business. And what we want to get to with the statement of cash flows is we want to look at, did our operating cash increase or decrease? Did our investing cash increase or decrease? Did our financing cash increase or decrease? And then what's the overall picture of where our cash is compared to where it was at the beginning of the accounting period? So we're going to look at where cash comes from, the sources, and where cash goes, the uses, and divide those into those 3 different categories. Now, why do we do this? Why is it important? Because it tells us important things about our business as far as liquidity and solvency. Do we have enough cash to keep the business going, to pay our bills, and to grow the business? So that's all coming from this cash flow piece, because it's telling us whether we're going to be able to do the things that we need to do and do the things that we want to do. Well, you might ask, can't we get this information from our income statement and our balance sheet? And let me give you a scenario that's pretty typical. So let's say that we have revenue of $10,000 and we have expenses of $5,000. So according to our income statement, we had a net income of $5,000. That should be adequate, right, to continue on with the business. But then let's jump over to the balance sheet and see what that shows us. Well, on the balance sheet, we have $1,000 in cash. We had $5,000 in profit. We had $10,000 in revenue, but we only have $1,000 in cash. And that's because our accounts receivable balance is at $5,000. So this is money that our customers owe to us. Maybe it's due, maybe it's overdue, maybe it's not due yet. But we've got a bunch of money sitting in our accounts receivable, and that's not available for us to pay bills or expand the business. Now let's say that $1,000 in cash has to cover payroll of $2,000 and accounts payable, the bills that are due right now, of $1,000. So you can see where that cash piece of it might be kind of important. And this is a pretty typical scenario, especially for small businesses. Or for a small business that gets to the end of the year and suddenly finds out they owe a bunch of taxes, and the business owner says, well, how can I owe taxes? I don't have any money. Well, this may be the secret that business owner doesn't know because they don't understand the statement of cash flows. So when you have a scenario like that where you have bills that are due, but you don't have the cash to pay them, then what are you going to do? Well, you can get on the phone and do what I call dialing for dollars, call your customers up, say, hey, can you pay that bill? Hey, can I give you a discount and you can pay the bill today? Or you take on debt in order to cover your current expenses. You run up your credit card debt, for example. Or the owner breaks into their piggy bank and puts more money into the business. So those three examples right there are exactly the three categories that we're talking about. We're talking about operating, our customers paying us. We're talking about financing, running up some debt, or we're talking about investing where the owner is putting more money into the business. So let's talk about some of the things that would fall under that operating category. We have things like paying rent, or if we're landlords, that's our business, then we would have receiving rent from our tenants. That would be a source of cash. We would receive cash from our customers. So they're either paying us cash at the beginning of the transaction, or they're going to pay that cash to us later when we collect our accounts receivable. We need to buy inventory so that we have it to sell to our customers. And we need to pay our employees so that they keep showing up every day. So those are some examples of sources and uses of operating cash. Under the investing category of cash flows, we would have things like buying or selling a building. So you need to buy a new factory, for example. Buying or selling a piece of machinery. So you have a new piece of machinery and you're no longer going to use the old piece, so you're going to sell it. You could also be buying or selling bonds in the business. So those are all examples of investing sources and uses of cash. Under the financing category, we would have activities like taking out a loan or making payments on a loan. You may be selling stock or buying stock back, or you may be paying dividends to stockholders. Those are examples of financing in a business. A business can finance either through debt or through equity, selling stock. So the statement of cash flows takes those three different categories and says, here's the things that happened in the operating, investing, and financing sections that either increased our cash or decreased our cash. And then we're going to look at the net increase or decrease in cash from all of those categories so that we can see, here's our beginning cash balance, here's our ending cash balance. Did we increase or decrease our cash? And what this is showing us is liquidity and solvency rather than profitability. So in our income statement example where we had $10,000 in revenue and $5,000 in profit, profitability was great. 50% profitability, that's wonderful. But it didn't show us liquidity or solvency. It didn't show us whether we have the cash to pay our bills and whether we can do things like grow the business or forecast out whether we can make payroll in a month. So the statement of cash flows breaks that down for us and gives us a better idea of what's going on in the business. Now, if you're watching this video because you want to understand financial statements, Your job here is done. If you're an accounting student and you need to understand how we actually come up with this report, you can go on to the other videos that show how to figure a statement of cash flows on the direct method and the indirect method so that you have a great understanding of what goes on behind the scenes in this very important statement of cash flows. Until next time, stay balanced, my friends. Imagine, if you will, a time long, long ago when a very young Carolyn was sitting at a desk, hunched over with her only light, the flame of a candle. She's toiled for hours and hours in a cramped, cold room, wishing that Mr. Scrooge would let her have one more lump of coal. But alas, no. Would her workday never end? Well, that's the era that we're going to be talking about today as we talk about closing entries. So something that we really don't do anymore except for in accounting class. Welcome to Accounting How To. I'm your host, Carolyn Grimm, and that's my sidekick, Mr. Scrooge. I mean, Terrence. So in this video, we are going to complete the accounting cycle, old school style. If you're one of my accounting students, you'll definitely want to hang on for this one. If you're a business owner or you're a bookkeeper, you could wander off and do something else and not watch this video. Go walk your dog, play with your kids, or if you just want to hang out with me because I'm the coolest accountant in the world, please feel free. So when we are talking about closing entries, the first thing we have to understand is the difference between a permanent account and a temporary account. And the best way that I can explain this is to think about a scoreboard. You're watching the Red Sox beat the Yankees, for example. Well, we go through 9 innings, we get to the end of the inning, and we say the Red Sox won, the Yankees lost terribly by a whole bunch of runs. It was a bloodbath. It was awful. Sorry. Well, when we go into the next baseball game, we don't carry that score forward. It goes back to 0 and we start all over again for the new game. Well, it's the same thing for our income statement accounts. We have collected all of that information all month long, and now we're like, great, we had this much in revenue, we had this much in expenses, and we've got a profit. Well, in the olden days, what we needed to do for the new month is we needed to zero out those accounts so that starting the new month, the new baseball game, we would be at 0 and we could begin to count the new innings, the new runs. So closing entries are a holdover from that. With accounting software, this is done automatically in the background. But back in the olden days when Scrooge and I were hanging out, sharing a piece of gristle, we had to do things in a manual way. Of course, Mr. Scrooge didn't do it. I had to do all the work. So we're going to go through those closing entries to show how we close out our temporary accounts, our revenues, our expenses, and our drawing accounts. And what's going to be left over when we've done that is our permanent account balances, which would be things like cash and accounts receivable, accounts payable, and our capital account. So here we go. I'm going to jump into the spreadsheet. Whoo! Whew. Wow. So when we're talking about closing entries, the place that we're starting is with our adjusted trial balance. And I've pulled that from the spreadsheet that we've been using for our other journal transactions and adjusting journal transactions. So here we are with our adjusted trial balance that we came up with before we did our financial statements here. And what we're looking at to close in our closing entries would be these accounts right here. So these are our temporary accounts. We're going to close out Joe Smith drawing. We're going to close out our 2 revenue accounts. We're going to close out our expense accounts. And when we're done with this old-fashioned exercise, we are going to end up with only these accounts still with a balance in them, our assets, our liabilities, and our capital account, our equity. So how do we do that? Well, there are 2 methods of doing closing entries. One is probably really old school, and the other one is a little less old school, but still pretty ancient. So closing entries method number 1 uses a new account called an income summary account. An income summary serves as a clearing account. We're going to move things in and out of it, and when we're done with it, the balance will be zero. Method number 2 skips that and just goes directly to the different accounts that we're impacting. So in method number 1, first thing we're going to do is we're going to close out our revenue account. So if we come over to our adjusted trial balance, we have 2 revenue accounts that we need to close out. So revenue accounts have a normal credit balance. So in order to close those out, we need to debit that amount. So here in our first closing entry, we're going to debit fees earned for $61,100, and we're going to debit rent revenue for $3,000. And the offsetting account is this new pass-through account called income summary. So our credit is to income summary. In the second closing entry, we need to close out all of our expense accounts so that they go back to zero and we're ready to start the new month fresh. So all of these expense accounts have a normal debit balance. So in order to close them out, we need to credit them. So here are all of our amounts from our adjusted trial balance for our expenses, and we are going to offset that by debiting this income summary account. Now let's pause there for just a moment and jump back to our financial statements. So here in our income statement, look at this. We've got $64,100 for total revenue. And here in our closing entries, we've got $64,100 going to income summary. And come back here, we've got $27,930 for expenses. And look, that's what we have here too. So we know we're on the right track. So right now, those balances, if we were to go post this right now, those balances would come to zero for our income accounts and for our expense accounts. But we're not done yet, because remember that we said our net income then becomes part of our capital. It's part of our owner's equity. So this ends up getting transferred up into our equity accounts. So let's see how that magically happens. So right here is our profit, right? So it's the difference between our income and our expenses. There's our profit. And we are crediting our Joe Smith capital account to increase his equity. And then the other side of that is our mysterious income summary account. So that's journal entry number 3. Now the final closing entry that we need to do is we need to close this drawing account into our capital account. So we are reducing Joe Smith's capital, and we are clearing that drawing account so that coming into the new month, we're starting at zero with that as well. We can't just make it go away. We need to capture the fact that Joe Smith's capital has decreased by that amount because he took some money out. So our final journal entry, closing entry, is to credit Joe Smith's drawing to empty that account and debit Joe Smith capital to reduce his capital amount. At this point, we go to our general ledger and we post those transactions just like we did with our regular journal entries and with our adjusting journal entries. And similarly to our adjusting entries, with the item right here, we're going to put closing so that we know this is a closing entry. We're doing it on the 20, and we would be entering that debit there, which would give us a balance now of 0. So once we've posted all of those accounts, what we're going to end up with is a post-closing trial balance, and that is going to include only our assets, our liabilities, and our equity, our capital account. So that's method number 1. With closing entries method number 2, it gets rid of that income summary piece. And here's what we do. We're still debiting our income accounts. We're still crediting all of our expense accounts. But instead of using this income summary Joe Smith capital entry, we are going right to the capital account. So we're cutting out that middleman account. So that brings this entry into balance because we have our revenue minus our expenses, and then the difference between the two is our net income. And then we still need to do the entry where we close out our drawing account into Joe Smith's capital account. That account is the same. So just like with closing entries, method number one, we would go into our general ledger, we would post all of those amounts, get the new balances, and then those new balances will come into our post-closing trial balance. These are the beginning balances for the new month. So we're always going to have our assets, our liabilities, and our capital accounts coming into the new month, and our expense and income accounts being returned to zero. Now, why am I giving you two methods for doing closing entries? As I mentioned, this is really only something that you're going to see in accounting class, right? And different textbooks will use these two different methods. So I could be teaching from one textbook, it's using method one, teaching from a second textbook using method two. So what happens in real life in the modern age, Mr. Scrooge has long gone to his reward, and I'm a much older accountant now. Well, accounting software does this automatically in the background. So you're never going to do closing entries other than in accounting class. So there you have it. That brings us to the end of the entire accounting cycle. So now we get to go home, we get to put our feet up, we get to see how Tiny Tim is doing, and then tomorrow we start all over again. So until next time, stay balanced, my friends. Round and round and round it goes, and where it stops, nobody knows. Today we're going to talk about the accounting cycle and how that impacts our workflow on a day-to-day basis. And then at the very end of this video, I'm going to give you some really good news. Welcome to Accounting How To, where we put the fun in accounting fundamentals. I'm your host, Carolyn Grimm, and that's my sidekick, Terrence. That is not my sidekick, Terrence, is it? Right. Terrence is on vacation this week. Never mind. Whoever you are, thanks for being here. So with accounting, there is a very particular order that we do things in. And we're going to travel through an entire month of doing those things. And then at the end of that month, we're going to start all over again for a new month because everything in accounting is driven by dates. So we're usually looking at a month for a period of time in which we're going to collect all of our information and then formulate that into some helpful reports. So let's go through step by step what that process is. And then, as I mentioned, at the end, I'm going to give you some news that you can use. So step number one, we're going to identify and analyze transactions. Now, what does that mean? Well, in our very first accounting class, it means we're going to go through a list of transactions that our textbook gives us, and we're going to say, what is this doing? What does this mean? What are we going to do with that? Are we debiting? Are we crediting? So we're going to go through and we're going to analyze those transactions. Now, in the real world, where we all live, that's a little bit different. We're not going to be given a list of transactions. We're going to be given a stack of invoices or a stack of bills from our vendors or payroll time cards. And that's the information that we're going to be pulling our information from. Step two, record journal entries. Now, as I mentioned with step one, in the real world, things are a little different. We're not going to do everything by journal entries as we do when we're learning accounting. We're going to be getting a stack of bills that came in the mail today, and we're going to be entering those into our software rather than doing manual journal entries as we did back when I was a dinosaur. Back when I was a young accountant. So journal entries are not something that's going to be done commonly for most people unless they are accountants. So journal entries are always going to be what's going on in the background of our software. So for example, if we are entering a bill that we're going to pay later, we're going to be debiting whatever expense and crediting accounts payable. But rather than doing that as a journal entry, we're just going to be telling our accounting software that this is a bill. We're going to code it to the whatever expense, and then it's magically going to do the other side of that without us telling it what to do because we've already told it that it's a bill. When we're doing an invoice for our customers, we aren't going to do that as a journal entry. What we're going to do is we're going to tell our software this is an invoice for our customer. And we're going to tell it what customer, and we're going to tell it what revenue account, but it's going to do the accounts receivable part of it without our intervention. But that's exactly what's going on behind the scenes. So the only time that you would be doing a journal entry would be a special occasion kind of thing, and it's going to be very rare. The one time you might be doing that is if you have an outside payroll service doing your payroll for you, and then you need to then enter that into your software as a journal entry. But journal entries would be a rare thing if you're using software. Step 3, post to the general ledger. So under manual accounting, we're taking all of our journal entries and we're saying, okay, we're going to go debit cash for $50 and we're going to credit accounts receivable or debit accounts receivable. So we're going to take all of those individual transactions that we did as journal entries, and then we're going to go post them in their individual accounts. So all of the cash parts will be recorded in the general ledger for the cash account, and all of the accounts receivable will be posted in the accounts receivable account. So it's a very manual process, and this is exactly the way that it was done when I started in accounting 35 years ago. Step number 4. So now we have posted all of those transactions into our general ledger accounts, and we're going to go in and we're going to make sure that our balances are correct. So as we posted to those accounts, we've kept a running total of what the balance is in that account. The end of the month rolls around, and we're going to take all of those amounts and we're going to bring them into this unadjusted trial balance. And all the trial balance is doing is it's listing out our balances from all of our accounts. And at the end of that trial balance, we're going to add up all of our debits, we're going to add up all of our credits, and we're going to make sure that they are equal. Now, it's not going to tell us whether we posted something in the wrong account. It's just going to say, did we debit and credit equal amounts in our accounts? So that unadjusted trial balance then carries into step number 5. And in step 5, we're going to make adjusting entries. So these are for accounts that need to be adjusted. It is not a correcting entry because something is wrong. It is an adjusting entry, a normal part of our accounting process. So for example, if we have unearned revenue, we have gotten a deposit from a customer, for example, and now we have done the work for that customer, we're going to move that revenue from unearned revenue into earned revenue. So what we're doing is we're looking at a certain set of accounts and we're saying we need to make some adjusting entries in order to make sure that those accounts are being tracked as they should be. So other things that might be in this category would be something like depreciation expense. That's not something you're going to get a bill for. This is just an entry that we're going to make once a month to record our depreciation expense. Another account that we might be adjusting would be, let's say, prepaid insurance. So you pay your insurance premium for the whole year, and then as each month passes, you're using up 1/12 of that amount. So you would do an adjusting entry to move it from prepaid insurance into insurance expense. So this is a normal part of our accounting cycle that we do. And for more information about that, of course, there's a playlist for adjusting entries. Now, step number 6, we're going to look at our unadjusted trial balance, what we did for changes within our adjusting entries, and we're going to record our new balances. So in the old school way of doing accounting, we would have taken those adjusting entries, posted them to the appropriate accounts, refigured our balances, and brought those balances into this adjusted trial balance. And it's called an adjusted trial balance because it's done after our adjusting entries. Once the adjusted trial balance is done, and we feel confident that we have good numbers that make sense, that are accurate, then it's time to prepare financial statements. And again, in the olden days, this was done in a very manual way. And we had to go through and pull all of those balances and put them into the appropriate financial statement. So then, once we've got our financial statements completed, we have more to do. So then we need to make closing entries. And the purpose of closing entries is to bring our revenue and expense accounts back to zero so that for the new month, we're starting our score from zero. We don't want to carry our old revenue or old expenses into the new month because that's going to skew our results. We want to be able to look at the results for just that month. So closing entries are a way of emptying out our buckets so that we can start fresh. So our assets, our liabilities, and our equity are not going to close out, right? We're not going to empty out our bank account and then open up a new bank account to put the money in the next month. We're just going to carry those balances. So the assets, the liabilities, and the equity accounts are called permanent accounts. Revenue and expenses are called temporary accounts. So we're going to empty those out. So once we make those closing entries, we've got one more thing to do. Then we need to prepare our third trial balance, and this is a post-closing trial balance. And that is going to have just your assets, liabilities, and equity balances on it. And it's showing that our revenue expenses are emptied out and we're ready to start the new month. So once you've got your post-closing trial balance done, your books are closed and you don't want to go back and touch anything prior to your closing date because that's going to mess up all of your other financial reports. So once you've done that post-closing trial balance, your monthly close, that's it. You don't want to go back and change things for the most part. Now, I promised you some good news. And here it is. Because of the wondrous invention of accounting software, there are only two of those things that we actually need to do. We need to enter our transactions and we need to do our adjusting entries. Everything else happens behind the scenes. We don't have to manually prepare any of those three trial balances because our software system is keeping tabs on everything that we do. We don't have to post things individually to individual accounts because that's all being posted automatically through our software. So the advent of accounting software is huge. So it's a huge labor saving. It's a huge reduction in the amount of mistakes that can happen. It's a huge reduction in your headaches because let's say you did a trial balance under the old way, the way that I grew up in, and you get to the bottom of that trial balance and your debits don't equal your credits. Now you've got to go back through all of your information and figure out what went wrong. And usually it's that you transposed a number or you put something in the credit column that should have been in the debit column. But it used to take hours and hours and hours to close the books every single month. But with computerized accounting, because we have everything posting as we go along, everything is up to date and we don't have all of those extra steps where human error can enter in. So that is your really good news for today. But that's the accounting cycle. That is the process that we go through. That is the process that is happening behind the scenes when you're using software. And it brings us back to that point of being able to run reports whenever we need to. So I'll see you next time. Stay balanced, my friends.